You walked into that dealership armed with facts you Googled at 11 p.m. The salesman smiled. You were wrong about almost everything. Here's the proof. 1. You can thank decades of pricing mythology for the belief that the sticker on the window is basically the dealer's cost with a greedy markup slapped on top, and that if you could just see the real number underneath, you'd finally have power in the negotiation. Every Karen who has ever slid a printout across a desk operates on this premise, and every single one of them is working with the wrong document. The MSRP, manufacturer's suggested retail price, is set entirely by the manufacturer, not the dealership. The dealer had almost no input in that number and cannot change it. What dealers actually pay is called the invoice price, and even that is not their true cost. Below the invoice exists a system of manufacturer to dealer payments called holdback, typically 2 to 3% of MSRP, paid quarterly after the sale closes regardless of what price the customer negotiated. On a $40,000 vehicle, that's $800 to $1,200 the dealer collects after you've driven away feeling victorious. On top of that, manufacturers pay dealers separate incentive money, called dealer cash, that never appears on any document a customer sees. Meanwhile, the dealer has been paying floor plan interest to the manufacturer's finance arm just to have that car sitting on the lot, roughly $30 to $50 per vehicle per day. A car sitting 90 days has already cost the dealership up to $4,500 before you showed up with your spreadsheet. The actual average front-end profit on a new vehicle sale sits somewhere between $1,000 and $1,500 industry-wide. Demanding to see the dealer's real cost is like demanding a restaurant show you the farmer's invoice before you'll pay for the pasta. The number you want doesn't mean what you think it means. 2. Somewhere between their third YouTube video and their second cup of coffee, a truly remarkable legal theory was born, that a car dealer is required by consumer protection law to negotiate, and that refusing to move off the sticker price is a federal crime you intend to report to whoever handles federal crimes about sticker prices. This is not a law. It has never been a law. There is no local, state, or federal statute requiring a car dealer to negotiate anything with anyone. Pricing is entirely at the dealer's legal discretion, full stop. The FTC's used car rule and related consumer protection statutes regulate disclosure of vehicle condition and financing terms. They say nothing, not one word, about mandating price negotiation. Several major retailers, including CarMax and Carvana, operate on explicit no-haggle, one-price models that are fully legal in all 50 states and have been tested repeatedly in court without a single successful challenge. Tesla's entire direct sales model is fixed price with zero negotiation, and federal courts have confirmed this is completely lawful in every jurisdiction where it has been challenged. The duty to negotiate myth almost certainly originates from decades of dealership culture where back and forth was simply the expected practice. Cultural norm quietly transformed into imaginary legal mandate somewhere between generations. The NADA actively supports dealers' right to set their own pricing structures, and no consumer agency has ever successfully argued that a legal obligation to negotiate exists. Some states restrict what dealers can charge in fees, but not whether they must negotiate the vehicle price itself. Telling a dealer they're legally required to lower the price because you said so is the equivalent of telling a restaurant they're legally required to split your check. You invented that law somewhere between the parking lot and the showroom door, and it did not survive the trip inside. 3. Every buyer who's watched a few too many car buying expose videos arrives at the dealership quietly, certain there's a secret warehouse of pristine, low-mileage vehicles being strategically withheld until the customer asks exactly the right question in exactly the right tone. The back lot. The overflow area. The hidden inventory they don't want you to see. Here's what actually lives back there. Cars awaiting PDI, pre-delivery inspection, vehicles mid-reconditioning, units with open safety recall repairs that cannot legally be sold in their current state, and wholesale units already flagged for auction because they don't fit this dealer's retail profile. Dealers operate under manufacturer floor plan agreements that actively incentivize fast inventory turn, meaning holding back sellable cars costs them real money every single day a unit sits unsold. There is zero financial logic to strategic concealment. More importantly, the entire inventory of virtually every franchise dealer in the country is digitally listed in real time on their own website, on Cars.com, on AutoTrader, and on manufacturer inventory portals. There's nothing to hide because hiding it would mean not selling it, which is the opposite of the business model. In-transit inventory, vehicles ordered from the factory but not yet delivered, is visible to any salesperson in the dealer management system and can be sold as an incoming unit before it even arrives on the lot. The secret back inventory concept is a holdover from the pre-internet era when information asymmetry between buyer and seller was genuinely significant. That era ended around 2005. Demanding to see the hidden stock is like insisting the grocery store is keeping the good strawberries locked in a vault. The strawberries are on the shelf. The ones in the back aren't ready to sell yet, and the ones flagged for auction are headed somewhere that isn't your driveway. 4. The moment Karen sees a dock fee, a dealer prep fee, a destination charge, and anything else that isn't the base vehicle price, the diagnosis is immediate. Every single one of these numbers was invented that morning by a bored accountant who needed something to do between actual transactions, and they represent 100% profit margin with zero cost underneath them. The reality is more complicated than that, and it requires about 30 seconds of patience to understand. Documentation fees cover title work, DMV registration filings, lien processing, and contract preparation. These are genuine administrative costs, though the profit margin embedded in them varies. 14 states cap doc fees by law, which is itself proof that the fees have enough legal recognition to require regulatory oversight. California caps them at $85. Florida caps them at $999. Colorado sits at $150. Destination charges are set entirely by the manufacturer, not the dealership, and they reflect actual freight costs from the assembly plant to the dealer. A truck shipped from a Kentucky assembly plant to a California dealer costs more to transport than one shipped 200 miles. Dealers cannot waive this charge because they already paid it when the vehicle arrived. Dealer prep fees, covering a basic wash, fluid check, and tire inflation performed by a lot attendant, are the most legitimately negotiable item in the bunch because the service is real, but the price often isn't proportional to the labor. Market adjustment fees are the most openly profit-driven and also the most legally transparent. They're disclosed on an addendum sticker, and you are free not to buy the car. The FTC requires all fees to be disclosed before contract signing. Screaming that all fees are invented doesn't make the DMV's title processing system disappear. You're not exposing fraud, you're just angry that paperwork costs money, which is a different complaint. 5. This one gets delivered with maximum confidence, usually about 30 seconds after the ink dries. I have 3 days to return this. The cooling off period. That is federal law. I know my rights. It is stated with the certainty of someone who has done research, who has prepared, who is absolutely not going to be taken advantage of today. Here is the problem. The FTC's cooling off rule, that's 16 CFR Part 429 for anyone keeping score, gives consumers 3 days to cancel certain door-to-door sales and sales made away from the seller's permanent place of business. A dealership showroom is explicitly excluded from this rule. The word explicitly is doing real work in that sentence. No U.S. state has a mandatory car return law for standard dealership purchases, not one. A few states require dealers to offer a return policy if they choose to advertise one, which is not the same thing as requiring any return policy to exist at all. California, the state most often cited as the exception, allows dealers to offer a 2-day return option as a paid contract cancellation option that buyers can purchase at signing. Dealers are not required to offer it, most don't. The myth likely spread because the cooling off rule does apply to some dealer-initiated off-lot sales events, like a tent sale at a fairground, and that narrow exception got generalized into a universal right that doesn't exist. Once a vehicle purchase contract is signed and the car leaves the lot, the transaction is complete in all 50 states unless the dealer and buyer mutually agree to unwind it. Dealers occasionally accept returns as a goodwill gesture, but they have zero legal obligation to do so. Citing the 3-day return law at a car dealership is like citing a warranty for food at a restaurant. The policy you're thinking of exists somewhere, just not here, not for this, and not the way you described it. 6. Karen has done the math in the parking lot. The salesman is making $3,000 on this deal. If you could just remove him from the equation, bypass the commission entirely, that $3,000 comes back to you. Simple subtraction. Except the average front-end commission on a new vehicle sale is not $3,000. It's somewhere between $150 and $300 flat, because most new car salespeople work on what the industry calls a mini deal structure. If a vehicle sells at or near invoice, the commission is a flat minimum, often $100 to $200 set by the dealership's pay plan. A salesperson earns a meaningful percentage-based commission only when the deal achieves significant gross profit above invoice, which is increasingly rare on new vehicles in competitive markets. The average dealer gross profit on a new car sits between $1,000 and $1,500. If the salesperson earns 25% of that, the commission is somewhere between $250 and $375, not the thousands of dollars the parking lot math assumed. The actual money in automotive retail is made in the finance office, not by the salesperson on the vehicle itself. Finance products, extended warranties, gap insurance, paint protection packages generate dramatically more dealership profit than the vehicle sale. Dealerships that have experimented with salary-based sales models, including AutoNation during their trials in the 2010s, did not lower vehicle prices as a result. Price is set by market conditions and cost structure, not by commission. And in most U.S. states, franchise laws legally require manufacturers to sell through licensed dealers. You cannot buy directly from the factory, regardless of how strongly you feel about cutting out the middleman. The salesman's commission is not why the car costs $40,000. Removing him saves you about what you'd spend on lunch. 7. Karen emerges from the finance office radiating fury. They ran my credit 12 times. That is illegal. You just destroyed my score on purpose to trap me in a higher interest rate. Setting aside the fact that no dealership has a strategic reason to damage the credit of the customer they're trying to finance, the underlying premise is wrong about how credit scoring actually works. Multiple credit inquiries for auto financing within a short window are treated as a single inquiry by FICO scoring models. This is not a loophole or an exception. It is a feature deliberately designed to protect buyers who are comparison shopping for loans. FICO's rate shopping policy groups all auto loan inquiries made within a 45-day window into a single hard inquiry for scoring purposes. Older FICO versions use a 14-day window. VantageScore uses a similar 14-day deduplication window. A single hard inquiry typically reduces a credit score by 5 points or fewer, a temporary dip that recovers within 12 months of normal credit activity. Dealers send applications to multiple lenders simultaneously specifically to find the best available rate for the customer. This is standard industry practice called a scatter submission. The Consumer Financial Protection Bureau has reviewed dealer credit practices extensively, and rate shopping inquiry bundling is not a violation of the Fair Credit Reporting Act. The confusion between the visible number of lender inquiries on a credit report and their actual scoring impact, which is deduplicated and minimal, is understandable. The outrage based on that confusion is not. Your credit score after a properly conducted auto loan application looks like it got a small scratch, not a totaling. The dealership didn't vandalize your finances. The scoring model already anticipated that you'd shop around because the people who designed it understood that car buyers comparison shop for loans, and they built the protection into the model before you arrived. 8. Both hands on the desk, full eye contact. I am legally entitled to see your invoice. That is a consumer disclosure requirement. Show me the document. Said with the confidence of someone who has watched exactly enough consumer advocacy content to feel dangerous, but not enough to be accurate. Dealers have zero legal obligation to show you the invoice price. It is a private business document, and no federal or state law mandates its disclosure to customers at any point in the transaction. The Monroney sticker, the federal window sticker, is the only price document a dealer is legally required to display, and it shows MSRP, not invoice or dealer cost. The Automobile Information Disclosure Act of 1958 created that sticker requirement and says nothing, not one word, about invoice disclosure. Here's the part that makes the demand almost comically unnecessary, even if it were legally required. Invoice pricing is already publicly available on Edmunds, TrueCar, and Consumer Reports. Anyone with a smartphone and 12 seconds can find it before walking onto the lot. The legal ultimatum is being deployed to obtain information that was freely accessible the entire time. Many dealers voluntarily show invoices as a trust-building sales tactic, but this is entirely at their discretion, not a compliance obligation. And even when shown, the invoice doesn't represent true dealer cost. Holdback and dealer incentives sit below it, making the document less revealing than the person demanding it believes. Using invoice disclosure as a legal ultimatum in the internet era is roughly 30 years past its practical expiration date. Demanding a dealer's invoice as a legal right is like demanding to see a hotel's laundry bill before you'll pay for the room. The law doesn't cover that, and you could have looked up the number before you left the house. 9. The finance office math seems simple from the outside. If you can get gap insurance from your regular auto insurer for $30 a year and the dealer is charging $900, that delta is fraud. It's price gouging. It's illegal. It's exactly the kind of thing you're not going to let happen today. The $30 a year figure is real. The $900 figure is real. The conclusion that they're the same product at different prices is where the analysis collapses. Insurer-offered GAPE endorsements typically cover the difference between your car's actual cash value and your loan balance, but some kept the payout at 25% of ACV and exclude negative equity rolled in from a previous loan. An exclusion that affects a substantial portion of buyers who trade in with remaining loan balances. Dealer-sold GAPE insurance, often underwritten by specialty companies, typically covers the full loan balance above ACV with fewer exclusions, and some products include deductible coverage of $500 to $1,000 on top of the gap amount. The $30 insurer add-on is frequently unavailable to buyers who finance through a bank or credit union rather than through their insurer, a restriction that applies to a large percentage of car buyers. Dealer gap is nearly universally overpriced at $900 to $1,200 when financed into the loan. The same or comparable coverage from a credit union typically runs $200 to $400. The correct move is comparing the specific policy terms, not just the headline price, and sourcing it independently before you step into the finance office. The $30 product and the $900 product are not the same item with different price tags. They're more like an umbrella versus a rain jacket. Both keep you dry until the specific storm arrives, and then the coverage details start to matter. 10. Karen points at the window sticker. This says $35,000. You're charging $42,000. That is a violation of the sticker price law. I want the manager, then I want an attorney, and then I want to know who regulates this. The manager appears. The attorney is not called. The regulation being cited does not exist. MSRP stands for Manufacturer's Suggested Retail Price, and the word suggested in that phrase, is not decorative. It carries legal weight and means the price is entirely non-binding on the dealer. Dealers are legally permitted to sell vehicles above sticker price. During high demand periods, this is standard practice, disclosed on addendum stickers, and has been tested in courts without a single successful challenge to its legality. During the 2021 through 2023 vehicle shortage driven by semiconductor supply chain disruptions, dealer markups on popular vehicles, Ford Broncos, Toyota Tundras, Chevrolet Corvettes, routinely ran $5,000 to $30,000 above MSRP. These were disclosed, legal, and upheld in every legal challenge brought against them. Some manufacturers, including Ford and GM, threatened to reduce vehicle allocations to dealers with excessive markups. A business relationship consequence, not a legal enforcement action, and a meaningful distinction. The FTC's revised CARS rule of 2024 requires upfront disclosure of all fees and add-ons, but it does not cap or prohibit above MSRP pricing at any dollar amount. The only vehicle pricing laws that exist are narrow anti-price gouging statutes in a small number of states, applying specifically during declared states of emergency, with contested applications to automotive sales that have not been broadly upheld. The sticker is a suggestion, not a price control order. Screaming that selling above it is illegal is like arguing a restaurant violated the law by charging $18 for a meal the cookbook priced at $12. 11. The sweeping decree arrives before the finance manager has introduced himself. Extended warranties are 100% profit, 0% value, designed by criminals to extract money from people who don't know better, and the correct policy is to refuse all of them, always on principle. This is presented as financial sophistication. It is the financial equivalent of refusing all restaurants because some have bad health inspections. Principled in theory, useless in practice. Factory-backed extended warranties from manufacturer CPO programs are underwritten by the automaker and honored at any franchise dealer nationwide. These are materially different products from third-party aftermarket contracts and treating them as equivalent. Because they share the word warranty is a category error with real financial consequences. Third-party VSCs, vehicle service contracts, vary enormously by administrator. Companies like Endurance and CarChecks and dealer-offered products from major underwriters have documented claims-paid histories. Others are thinly capitalized operations that deny claims aggressively and disappear when tested. The average drivetrain repair, a transmission replacement, a major engine repair, runs $3,000 to $8,000. A warranty that covers one such event at a cost of $1,500 is mathematically positive expected value for that specific repair. Buyers of luxury European vehicles post-factory warranty show statistically higher repair frequency and cost. Coverage in that segment has measurable actuarial value that blanket refusal ignores. The correct approach is evaluating the specific contract's covered components list, its exclusion language, its deductible structure, and the administrator's AM Best financial stability rating. The dealer's markup on the product is nearly always negotiable. The product itself may have genuine value. These are two separate facts. Refusing all extended warranties because some are bad is the equivalent of refusing all medicine because some has side effects. Read the contract. Make a decision with information rather than ideology. 12. Delivery day arrives and Karen is absolutely certain they switched the car. The trim got downgraded, the features disappeared, the VIN changed between Tuesday's test drive and today's delivery. She's seen the stories. She knows how this works. She is prepared. Every vehicle sold in the United States has a vehicle identification number on a 17-character identifier unique to that specific car, stamped into the dashboard, the door jamb, and the engine block, and printed on every single sales document in the transaction. A dealer substituting a different vehicle than what was contracted would require forging the sales contract, falsifying the title application, and submitting fraudulent documents to the DMV simultaneously. That's multi-count felony exposure at the state and federal level for every employee who touched the paperwork. The NHTSA maintains a public VIN lookup database where any buyer can verify a vehicle's year, make, model, trim level, and factory-installed options in under 2 minutes at no cost, using only the number printed on the dashboard that is visible through the windshield. A vehicle delivery inspection, conducted by the buyer at handover and documented in the purchase agreement, is standard practice. Any discrepancy between the contracted vehicle and the delivered vehicle is a documented breach of contract. The myth persists partly because legitimate issues do occur. Dealer-installed accessories added without consent, features the buyer misunderstood as standard equipment rather than the optional upgrades. These are communication failures and occasionally compliance issues. They are not vehicle substitution. Carfax and AutoCheck reports are tied to a specific VIN and would immediately reveal if a different vehicle was presented. The VIN is the car's fingerprint. It's on the dashboard where you can read it with your eyes before you hand over a check. If the numbers match, and they will, the car is the car. 13. Karen demands that the finance manager disclose every rate received from every lender and provide the absolute lowest one available. Because withholding a better rate is fraud, it's consumer deception, and she is not leaving this office until she sees the full rate sheet. There is no law requiring this disclosure. The mechanism she's unknowingly objecting to is called dealer reserve, and it is a legal, disclosed profit structure built into automotive financing that the CFPB has reviewed, published guidance on, and explicitly declined to prohibit under current federal law. Here is how it works. The dealer buys a loan at one rate, the buy rate set by the lender based on the buyer's credit profile, and sells it to the customer at a higher rate, keeping the spread as income. On a $35,000 loan at a 2% rate markup over 60 months, dealer finance reserve approximates $2,200 in profit that never appears as a line item on the contract. The CFPB's 2013 indirect auto lending guidance attempted to limit discriminatory application of rate markup, but was overturned by Congress in 2018 under the Congressional Review Act. The consumer protection mechanism here is not demanding a rate sheet. It is arriving with a pre-approved competing rate from a bank or credit union, which establishes a rate ceiling and forces the dealer's finance office to compete or lose the financing income. Captive lenders subvented rates, manufacturer financing promotions like 0% APR for 36 months, are the lowest available rates and are disclosed because they function as marketing tools. Everything else involves dealer reserve. The finance office is a profit center, not a charity sorting through lender offers on your behalf. Come with a competing rate or pay for the privilege of not having shopped around in advance. The markup is legal, and it is technically in the disclosure documents you signed. 14. Karen has watched the strategy video. The instructions were clear. Negotiate the new car price first, lock it in writing, then negotiate the trade-in. Keep them completely separate so the dealer cannot move money between boxes. It is a sound framework that breaks down the moment you believe that separating the conversations in negotiation means the dealer cannot see both numbers simultaneously in their desking software. Experienced deal managers can adjust the overall transaction structure even after both numbers appear to be agreed, because the total transaction is a system, not two isolated deals, happening in sequence. The four-square negotiation method, a sheet divided into purchase price, trade value, down payment, and monthly payment, was specifically designed in the 1980s to allow flexible, simultaneous manipulation of all four variables in ways that obscure the actual economics for the buyer. Keeping negotiations separate is the correct consumer strategy, but it requires the buyer to verify final numbers against each agreed figure before signing, because the finance office produces one integrated contract. If you negotiated the vehicle to $38,000 and the trade to $12,000, the net cost should be $26,000 before taxes and fees. If the final contract shows different math, the deal was restructured. Dealers may concede on trade value while recapturing gross on the vehicle price, or offer apparent generosity on the trade while adjusting dealer fees. Dealership desking software, including MaximTrack and DealerSocket, optimizes deal structure in real time, balancing concessions across variables to maintain target gross profit. The consumer defense is not dramatic separation of the conversations. It is knowing your target out the door number and measuring the final contract against it regardless of which individual line changed. Negotiating as if the boxes don't talk to each other doesn't work when the dealer's system connects all of them and you don't have the login. 15. The power move. Refuse to deal with the salesperson, demand the manager by title or name, imply you're a serious buyer with a limited schedule, and watch the deal get better immediately, because managers are terrified of losing transactions and will discount on contact to avoid the loss. This is not how dealerships are structured, and it reflects a fundamental misunderstanding of who is actually running your deal. In a standard dealership, the sales manager, also called the desk manager, already controls the deal from the moment you walk in. Every offer the salesperson presents has been structured or approved by the manager working behind the glass. The salesperson is a delivery mechanism, not the decision maker. The TO, the turnover to management, is itself a sales technique, not a capitulation. Managers are trained specifically in closing deals that salespeople couldn't close, not in offering deeper discounts to customers who demanded escalation. Research from JD. Power and industry training organizations including Reynolds consistently shows that buyer pressure tactics occasionally work, but primarily when the deal was already near the dealer's floor price, meaning the escalation coincided with an inevitable outcome rather than caused one. Walking out genuinely, not theatrically, and following up by phone or email the next day produces measurably better outcomes than escalation demands made on the lot, because it removes the time pressure that advantages the desk manager. The "get me the manager" move is so common in automotive retail that every manager in the building has a trained response to it that was developed specifically to protect the deal. Demanding the manager is like escalating to customer service's supervisor, hoping you'll get something the frontline rep wasn't authorized to offer. Sometimes it works. Mostly, it gets you a different face delivering the same answer at the same number. 16. Karen arrives with a bank pre-approval letter and delivers the announcement. Her financing is done, final, non-negotiable, locked, and the dealer is legally required to process the sale using her bank's loan. She read this somewhere. It is entirely untrue. A dealer is a private business and may choose which financing sources it works with. If your bank requires paperwork the dealer doesn't support, or if the bank has no established dealer relationship with this store, the dealer can decline to work with that lender without violating any law. However, the practical reality is that most major banks, Chase, Bank of America, Wells Fargo, and most credit unions have established dealer relationships and can fund deals at franchise dealerships with minimal friction. "My bank won't work here" is a rare scenario, not a common one. The confusion is between the right to bring your own financing, entirely reasonable, respected at most dealers, and a strong negotiating position, and a legal obligation on the dealer to process it regardless of their lender relationships, which does not exist. Pre-approval gives you a rate ceiling, not a mandate over the dealer's operations. If the dealer's finance office can source a lower rate than your bank, accepting dealer financing may be the correct financial decision for your specific loan, which is worth evaluating rather than refusing on principle. Some dealers price manufacturer incentives or dealer cash to be accessible only with in-house financing. a legitimate business structure that affects which option is actually cheaper for the buyer after all rebates are applied. The dealer doesn't have to use your bank any more than a contractor has to use your cousin's lumberyard. They might, if the terms work for both parties. But I already arranged this as a preference, not a binding instruction over their business operations. 17. Karen checks the fuel gauge at delivery, sees half a tank, and the theory forms instantly. The dealer deliberately siphoned her gas as a cost-cutting measure, and she will not accept the vehicle until it arrives with a full tank because that is basic respect and also possibly a legal requirement. The dealer did not drain anything. New vehicles leave assembly plants with 1 to 3 gallons of fuel, enough to complete end-of-line quality checks and drive the car onto a transport carrier. This is a manufacturing process decision made at the factory level, not at the dealership. Vehicles then travel from assembly plants to regional rail hubs via auto-rack train cars, and from there to dealerships via car hauler trucks. None of these transport steps include stopping at a gas station. Dealer PDI checklists at most manufacturers do include fueling the vehicle before customer delivery, but standards vary. Some manufacturers specify topping off, others specify a minimum level, and execution depends on lot staff and timing. Fuel cost relative to the transaction is trivial. Filling a 16-gallon tank at $3.50 per gallon is $56. No dealer is engineering a gas theft strategy on a $40,000 transaction to save $56 per unit. Long-term lot storage and the multiple short drives that occur during reconditioning, manager test drives, and PDI road tests do gradually reduce fuel levels from whatever level the car arrived at. A full tank at delivery is a reasonable customer expectation and standard practice at most reputable dealerships. Asking for a fill is entirely appropriate. Declaring it a deliberate conspiracy worthy of escalation is a different category of complaint. The car came from a factory, not a gas station. The dealer didn't steal your fuel. Request the fill, get it, and move forward. 18. Karen paid for a certified pre-owned vehicle, and the expectation is absolute. Certified means perfect, it means accident-free, it means the vehicle has never experienced a problem of any kind, because that is what the word certified communicates, and the dealer owes her a perfect vehicle. CPO means a vehicle passed a manufacturer-defined inspection checklist and was reconditioned to a specified standard at a particular moment in time. It does not mean accident-free, problem-free, or issue-free. And the inspection checklist itself varies significantly by manufacturer in ways that matter. Toyota's 160-point inspection, BMW's CPO process, and Chevrolet's 172-point checklist are not equivalent. A higher point count does not indicate more comprehensive coverage. It reflects how granularly individual steps are itemized. Most CPO programs accept vehicles with prior accident history provided. The damage was repaired to manufacturer standards. A Carfax showing a prior accident on a CPO vehicle is common and does not represent a program violation. Reconditioning under CPO standards means bringing the vehicle to a functional and cosmetic standard, not replacing all high-wear components or guaranteeing future reliability of parts showing no current failure at the time of inspection. CPO status does not erase a vehicle's history. It means a franchise dealer inspected it under current manufacturer guidelines on a specific date. The CPO warranty. The actual financial benefit of the program varies dramatically between brands. Some extend the original factory warranty, some add new powertrain coverage, some include roadside assistance, and some are narrower than buyers assume. Paying a CPO premium for the badge without reading the accompanying warranty document is one of the most expensive misunderstandings in used car retail. Certified means someone checked a list and the car passed on that day. It is not a birth certificate proving a spotless life. The warranty document is what does something. Read it before you assume the label does the work for you. 19. The monthly payment negotiation walk-in is one of the most reliable ways to pay dramatically more for a vehicle than you need to, and the dealership knows exactly what to do the moment you announce your number. When you sit down and declare that you want to be at $400 a month, you have just handed the finance structure entirely to the other side of the table. Monthly payment is a function of 3 variables: purchase price, interest rate, and loan term. Stretching a loan from 48 to 84 months reduces the monthly payment while dramatically increasing the total amount you pay. A $35,000 vehicle at 7% interest over 48 months costs you $41,120 total. The same vehicle at the same rate over 84 months costs $45,227. a difference of more than $4,000 that produces an apparently lower monthly number and feels like a negotiating win. Dealers trained in payment-focused selling bury excessive price and inflated interest rates into extended loan terms. You see $399 a month and feel victorious. The desk manager has hit target gross profit and moved on to the next deal. Industry training organizations, including Joe Verdi Group and Reynolds University, specifically teach salespeople to move customers from price conversation to payment conversation as early in the process as possible, because payment-focused buyers are statistically among the least financially protected in any automotive transaction. The correct negotiating unit is the out-the-door price, vehicle price plus taxes, fees, and all required charges, net of trade value. Payment is a calculator output derived from that number, not a negotiating position. Buyers who anchor on monthly payment frequently don't know their interest rate, their loan term, or their actual purchase price by the time the contract is placed in front of them. You can always get the payment lower by making the loan longer. You cannot get those extra years of interest back. 20. The out-the-door price gets locked in writing, or so you believe, and you arrive at the finance office expecting a rubber stamp confirmation of the number you negotiated yesterday. Then the contract is $3,800 higher than the agreed figure, and you declare the dealer violated a legally defined term that protects you from exactly this situation. Here is the problem. Out the door is industry slang. It has no legal definition. No federal statute, no state motor vehicle code, and no regulatory agency defines the scope of what an out-the-door price must include. What a dealer includes in an OTD quote varies by store, by salesperson, and sometimes by day. Standard OTD quotes typically include vehicle price, dealer fees, and sales tax. They commonly exclude DMV and registration fees because these are calculated by the DMV based on the buyer's county of residence, vehicle weight, plate type, and other variables that cannot always be pre-calculated with precision. The binding document is the retail installment sales contract signed in the finance office. All consumer protections attach to what's in that document, not to a handwritten number produced during negotiation. The FTC's 2024 CARS rule requires dealers to clearly disclose all charges before contract execution, which significantly improves the regulatory environment, but the out-the-door quote produced during negotiation remains an informal figure, not a legally enforceable contract term. The correct approach is requesting an itemized breakdown of the OTD figure rather than a single total number, so that any addition in the final contract is immediately visible and identifiable. Out the door is a phrase, not a statute. Ask for the line-by-line version in writing and measure every item that appears on the final contract against it before the pen touches anything. The phrase alone is not a legal force field around the total. 21. The website shows $28,999. You've driven 40 minutes to the dealership, and you are now informing the sales manager that advertising law requires them to honor that exact price because bait and switch is illegal, and you have the printout right here. Advertised prices carry genuine legal weight, but they come with conditions, and those conditions are where the gap between the website and the sticker lives. FTC rules on deceptive advertising do prohibit bait and switch in a straightforward sense. Advertising a price for a vehicle the dealer never intended to sell at that price is an actionable deceptive practice. However, availability conditions attached to the advertised price are legal, provided they are disclosed. Advertised prices frequently incorporate stacked rebates, a manufacturer rebate, plus a loyalty rebate, plus a financing rebate, plus a military discount, for example, that apply only to buyers who qualify for all of them simultaneously. If you qualify for none, the price adjusts, legally. Dealer advertisements are regulated primarily at the state level by attorney general offices and motor vehicle dealer licensing boards, and standards vary significantly across states. The price displayed on a dealership website is often pulled from an inventory management system that may lag real-time market adjustments by hours or days, particularly on high-demand vehicles. Under the FTC's revised CARS rule, dealers are required to disclose that an advertised price reflects specific conditions before the buyer invests significant time in the process. Airline prices are also advertised and also different by the time you reach checkout. The base fare was real. The qualifications attached to it were in the terms. Car advertisements operate the same way, and the correct consumer behavior is confirming which rebates are factored into the price in writing before making the drive. The printout is a starting point, not a purchase order. 22. Whatever they offer first, you counter at 20% below, because the first number is always pure padding, always inflated, always designed to be rejected, and the real price is buried 20% underneath it, waiting for someone bold enough to demand it. This heuristic was developed in an era when new vehicle margins ran high enough to absorb 20% counters without approaching dealer cost. That era is gone. Average new vehicle front-end gross profit has declined from $2,000 to $3,000 in the pre-internet period to approximately $1,000 to $1,500 in the current market, according to Nadia industry data. On low-margin, high-volume vehicles, a Toyota Camry, a Honda CR-V, a base-trim Ford F-150, the dealer's first offer may already be near or at invoice, with only holdback remaining as the dealer's cushion. A 20% counter demand on those vehicles is mathematically impossible for the dealer to fulfill without taking a loss. On low-volume, high-demand vehicles with constrained supply, the first offer may be above MSRP, and the dealer's willingness to negotiate depends entirely on how many qualified buyers are in the pipeline for that specific unit, not on a percentage rule you brought from a personal finance subreddit. The 20% rule is a functional negotiating tool on certain slow-moving used vehicles, on specific new models, in oversupplied configurations, and in specific market conditions. It is not a universal law of automotive physics. Consumers who apply rigid percentage counters without first establishing the vehicle's actual market value through Edmunds' True Market Value or regional competitive listings are negotiating completely blind against a dealer who has access to live market data updated daily. Counter the first number with something real. Applying a fixed percentage to an unknown baseline is not strategy. It is confidence applied to a guess. 23. The window addendum sticker lists paint protection, nitrogen-filled tires, wheel locks, and a VIN etching package for a combined total of $1,800, and Karen declares every item fraudulent, worthless, and removable from the deal because she did not request any of them, and therefore they do not exist in any binding sense. Two separate facts are being merged into one wrong conclusion here. Some add-ons are pre-installed before the vehicle arrived on the lot. Some are elective upgrades offered at the point of sale. These are different categories with different negotiating implications. Pre-installed items, paint protection film, applied tint, cargo accessories, cannot be physically removed from the vehicle because they are already on the vehicle. What you can negotiate is the price assigned to them, or you can offset that price against the vehicle purchase figure. Elective add-ons that have not been applied can simply be declined. Nitrogen-filled tires at dealer prices of $150 to $250 represent a meaningful markup over the actual cost of the service, which runs $5 to $10 per tire at a specialty shop. The underlying science is real. Nitrogen maintains tire pressure more stably across temperature changes. But the margin is not. Wheel locks are functional anti-theft devices available at any auto parts retailer for roughly $20. The dealer charges $150. VIN etching has modest anti-theft utility and is available as a DIY kit for under $20. The addendum price on the sticker is not mandatory. It is a presented asking price. But the pre-installed item is on the car, regardless of how you feel about the sticker. Refusing the product entirely because the price is wrong costs you the item. Negotiate the price, source independently post-delivery, or offset it against the vehicle cost. Pick one. The cheese is already on the burger. 24. Karen finds out during the negotiation that the dealer ran a soft credit pull and announces she's filing an FCRA complaint because they accessed her credit report without explicit written consent, and that is a federal violation she intends to document and pursue. The Fair Credit Reporting Act distinguishes between hard inquiries, which require explicit authorization, appear on your credit report, and can affect your score, and soft inquiries, which are permitted under certain permissible purposes and do not affect your score. Dealers are permitted under the FCRA to conduct soft pulls for pre-qualification purposes when a consumer is actively engaged in a vehicle transaction. This is classified under the review account or promotional permissible purpose category, which does not require the consumer's signed authorization because it does not carry scoring consequences. A hard inquiry, the type that requires signed authorization, cannot be run without the buyer's explicit written consent, typically provided through a credit application form that is part of the buyer's order paperwork and contains authorization language in the text. The FTC has litigated FCRA enforcement actions against dealers who ran hard pulls without authorization, and these cases involve specific documented violations of the hard inquiry requirement, not routine pre-qualification soft pulls. Consumers have a clear right to know when a hard inquiry was run and by whom, the right to dispute unauthorized hard inquiries, and the right to a free annual credit report disclosing all inquiry activity. If a hard inquiry appeared without your signature on a credit application, that is worth pursuing. If it was a soft pull used for pre-qualification, the complaint has no regulatory basis, your score is unchanged, and the filing would be a significant investment of time in exchange for a determination that nothing improper occurred. A soft pull during a car negotiation is the financial equivalent of checking flight availability before booking. Your score is fine. 25. Karen signed everything, drove the car home, and received a call 3 days later saying the financing didn't go through and she needs to come back in to restructure the deal or return the vehicle. And she now believes this is a universal dealer tactic that can happen to anyone at any time with no warning and no legal remedy. Yo-yo financing is a real practice with a real name and documented regulatory attention, but understanding what it is and when it applies changes the picture considerably. It occurs when a dealer delivers a vehicle conditionally, with final lender approval still pending, and later calls the buyer to renegotiate or return the car when the lender declines or modifies the terms. For this to be legal, the conditional nature of the delivery must be disclosed in the purchase agreement. Dealers execute conditional deliveries primarily on subprime credit applicants where lender approval is genuinely uncertain at the time of signing. Buyers with prime credit scores above 700 and straightforward financing rarely encountered this scenario. California's Reese-Levering Motor Vehicle Sales and Finance Act heavily restricts conditional delivery terms and provides significant buyer protections, giving dealers a narrow procedural window and strict requirements for any rescission. The CFPB published a 2015 supervisory bulletin specifically identifying yo-yo financing as an unfair, deceptive, or abusive practice when used to coerce buyers into worse terms they didn't originally agree to. If you receive that call, the first step is reviewing whether the delivery was explicitly conditioned on financing approval in the contract you signed. That sentence is the one that determines your legal position. If it was not in the contract, contact a consumer attorney. If it was clearly disclosed, you are in a different situation. Yo-yo financing is worth knowing about. It is not a random weapon deployed on every buyer who drives off the lot. 26. Karen examines a used car sticker, decides the dealer bought it for roughly the asking price minus 15%, and negotiates based on that assumed cost structure. Confident she understands the margin she's negotiating against and the approximate number the dealer needs to walk away happy. Used car retail pricing is not built on a uniform cost-plus margin formula, and the assumption that it is produces negotiating strategy built on a foundation that doesn't reflect how any of these vehicles were actually acquired. Dealers source used vehicles through 4 channels: trade-ins, lease returns, wholesale auction, and direct purchase from individuals. Each channel produces a different acquisition cost for the same vehicle, making a single assumed margin percentage wrong by design. Auction acquisition adds buyer's fees of $300 to over $600 per vehicle, transport costs, and arbitration risk. Costs invisible to the retail buyer that vary by vehicle and market. Reconditioning costs, applied before retail pricing, range from a few $100s on a clean trade-in to $2,000 to $3,000 on a high-mileage vehicle with deferred maintenance. Dealers use live market data tools, including Viato and CarGurus market analysis, to price used vehicles based on competitive local listings and days on market velocity, not on a cost-plus formula. A trade-in acquired for $8,000 and an auction vehicle of the same year and model acquired for $11,000 may be retailed at the same sticker price if current market data supports that figure. The price reflects the market, not the acquisition. Gross profit on used vehicles averages $2,000 to $3,000 per unit at the front end, per NADA data. Higher than new vehicles precisely because market pricing variability creates more negotiating range. The sticker price is where the market says the vehicle belongs today, not your dealer's purchase price plus 15%. 27. Karen has decided that independent shops are simply better than dealer service departments. Dealership technicians are factory robots who follow checklists without understanding what they're doing, charge 3 times as much for inferior work, and exist primarily to generate unnecessary repair recommendations rather than actually fix anything. This conviction ignores what franchise dealer technicians actually train on and what tools they actually have access to. Manufacturer certification programs including Toyota T10, Ford FACT, GM ASEP, and ASE Master Technician designation require brand-specific training modules, manufacturer exams, and continuing education that independent shop generalists may not match for knowledge of your specific vehicle's architecture. Factory scan tools and proprietary diagnostic software give dealer technicians access to calibration data, software updates, and technical service bulletin information in formats that independent shops must approximate with aftermarket alternatives, sometimes equivalent, occasionally not, particularly on late model vehicles with complex electronic and driver assistance systems, for warranty-covered repairs requiring manufacturer-specific programming, ADAS recalibration, transmission reprogramming, or airbag module coding. Dealer service departments have factory access that independent shops typically cannot replicate regardless of their general competence. ASE certification is held by technicians across both channels and is not an exclusive credential of independent shops. Dealer technicians work on flat rate, paid per operation completed rather than by the hour, which incentivizes speed and creates a legitimate conflict of interest around recommending additional services. That dynamic is real and worth knowing. Independent shops typically offer lower labor rates and often more personal service on routine maintenance, where brand-specific knowledge is not the differentiating factor. A brake job is a brake job. A complex electrical fault on a 6-year-old European SUV is a different conversation. The specialist and the generalist both have value. The question is which one you need for the specific problem in front of you. 28. One pricing website produces a number, and that number is declared the immutable, scientifically established, legally valid market value of the vehicle. And any deviation from it is dealer fraud that Karen intends to document and report to whatever agency handles the distance between KBB and a sticker. Vehicle valuation is an estimate generated by models with documented variation between sources, regional adjustability, and condition assessment limitations built into every output they produce. The major valuation sources, Kelley Blue Book, Edmunds True Market Value, NADA Guides, Black Book, and Mannheim Market Report, use different methodologies and different data sources and regularly produce values for the same vehicle that differ by $1,500 to $3,000. KBB consumer-facing values are calibrated toward what buyers expect to pay at retail and are not the wholesale auction benchmark dealers use for acquisition decisions. Edmunds TMV is based on actual transaction data from dealer sales and adjusts regionally, generally considered closer to real transaction prices for new vehicles. Condition grades on consumer valuation sites, poor, fair, good, very good, excellent, are self-assessed by the user submitting the inquiry, and owner self-assessment consistently skews toward excellent, inflating perceived trade-in value by a measurable and documented average. Regional demand affects actual market value significantly. The same truck trim in Dallas and Seattle may genuinely trade at a $2,000 to $4,000 spread because of local demand patterns, inventory availability, and fuel cost sensitivity. True market value for any specific vehicle in any specific market on a specific day is determined by what a willing buyer pays a willing seller in that transaction, an aggregate that websites model but do not determine. One pricing website is a weather forecast, not a court order. It is a model's best estimate. The actual price of this car, today, in this market, is what someone will pay for it, and that number has never appeared on any website. 29. Karen is providing the full legal analysis. The $31,000 change after signing was illegal, the contract is void, and the fact that someone typed her middle initial wrong on page 3 means she's not paying for any of it, and the dealer can keep the car while she contacts whoever handles automotive contract nullification. Contract law distinguishes between typographical errors and material misrepresentation, and courts have been making this distinction consistently for long enough that the outcome is predictable. A wrong middle initial, a transposed phone number, or a fee listed on an incorrect line are clerical errors. Contracts are remedied through correction and resignature, not through voiding. The retail installment. Sales contract in most states is a standardized form, regulated by the state banking department or attorney general, and specific fields carry specific accuracy requirements. Errors in key financial terms, the APR, the total amount financed, the total of payments, are addressed under the Truth in Lending Act, which provides defined remedies for material disclosure errors, including, in limited circumstances, a right to rescind. Material TILA errors are worth pursuing. A wrong middle initial is a 2-minute correction. Automotive purchase contracts contain amendment provisions, typically a line allowing both parties to initial corrections, specifically because minor transcription errors occur in multi-page documents involving dozens of data fields. Attempting to void a contract over a clerical error as a legal strategy is unsuccessful essentially across the board in consumer automotive case law and can expose the party attempting it to breach of contract counterclaims. The FTC's CARS rule addresses undisclosed fee additions, which is the category worth paying attention to. A transposition error on a personal detail is in a different universe from a material misrepresentation of financial terms. Fix the typo. Reinitial. That is the process. A typing mistake does not produce a complimentary $40,000 vehicle. 30. The sweeping theory. The dealership's actual business model depends on concealing fees in unreadable fine print, timed precisely to the moment when the buyer is too exhausted, too rushed, or too far committed to process the language. And that this mechanism is the primary profit engine of automotive retail. The fine print problem is real in a specific documented sense. The primary profit centers of a dealership are not hidden text in a contract. They are disclosed revenue streams including finance reserve, F&I product sales, used vehicle margin, and service department income, all of which operate in frameworks that require disclosure even when the disclosure is imperfect. The FTC's CARS rule of 2024 specifically prohibits junk fees, charges not disclosed before purchase commitment, and requires all fees to be itemized and disclosed up front. This regulation was enacted in response to real documented abuses, which means the problem existed. It also means it is now a compliance violation with enforcement consequences, not an industry-wide business model operating freely. Federal Truth in Lending Act regulations require the APR, total amount financed, finance charge, and total of payments to be disclosed in standardized, prominent format on the risk. The most financially important disclosures are regulated in font size and placement, not buried. The practical risk is speed, not font size. A finance manager moving through paperwork quickly, relying on buyer fatigue rather than illegible text, is the actual mechanism. The remedy is your right to read at your own pace, which exists in every state and cannot be legally overridden. Buyers have the explicit right to take contract documents home before signing in most states. A dealer who refuses this request is the specific red flag worth acting on. Slow down. Read every line. The document isn't hiding from you. You're just being moved past it. 31. Karen chooses the no-haggle dealer specifically because she believes the fixed price represents a best value consumer commitment, that one price selling exists because the dealer decided to be honest, to eliminate the markup, to offer fair pricing to everyone equally as a matter of principle. No-haggle pricing eliminates negotiation friction. It does not eliminate margin, guarantee market competitiveness, or remove profit from the transaction. It is a pricing model, not a pricing philosophy. CarMax, the largest used vehicle no-haggle retailer in the country, reports gross profit per used unit consistently above $2,000 per transaction. The no-haggle model produces predictable margins at scale, not thin margins driven by consumer preference. Consumer satisfaction research from J.D. Power consistently shows that no-haggle buyers report higher process satisfaction scores than traditional dealership buyers. The same research does not show that no-haggle buyers pay lower prices for comparable vehicles. Satisfaction is higher because the experience is less stressful, not because the price is more favorable. No-haggle vehicle pricing is benchmarked against the same market data used by traditional dealers: Manheim auction data, Black Book, competitive listing analysis. It reflects the dealer's chosen position within the market range, not a cost-derived floor arrived at through ethical commitment. Some no-haggle dealers adjust prices periodically based on days on market velocity. A vehicle priced at $24,995 in week 1 may drop to $22,995 by week 6 as market data triggers a price revision. The fixed price is fixed at a moment, not permanently. Comparing any no-haggle price against current competitive listings on Cars.com or AutoTrader remains the only way to assess whether the fixed price is actually favorable for that specific vehicle. No haggle means no arguing. It does not mean no margin. The dealer chose a price that didn't require negotiation to remain profitable. 32. Karen announces she's a cash buyer and waits for the discount to materialize. because cash is king. Cash saves the dealer processing headaches, and cash buyers have always gotten better deals than people who finance through the store. Cash purchases are not advantageous for dealers. They produce less total revenue than finance purchases because the dealer earns no financing profit from a cash transaction, and financing profit is one of the primary revenue streams in automotive retail. A finance vehicle purchase generates dealer income from two sources: vehicle front-end gross and finance reserve, the interest rate markup discussed earlier. A cash purchase generates only front-end gross. On a $40,000 vehicle financed at a 2% rate markup over 60 months, dealer finance reserve approximates $2,200 in income that a cash deal produces exactly zero of. Dealer finance departments track penetration rate, the percentage of deals financed through the store's FI office, as a performance metric that affects manufacturer relationship scoring at some brands. Cash deals reduce that metric without financial compensation. The processing fee savings from cash are minimal. Credit card interchange fees of 2 to 3% are already limited or refused on large vehicle purchases. Bank check processing is a trivial cost that doesn't offset the financing income lost. Manufacturer rebate programs frequently require dealer-arranged financing for specific terms to unlock the full rebate amount. Cash buyers may qualify for smaller incentives than finance buyers on the same vehicle after all programs are applied. The correct use of the cash buyer identity in negotiation is to signal that finance office products won't be purchased, to anchor the conversation on the vehicle-only out-the-door price, and to avoid the payment-focused conversation entirely. Announcing you're paying cash and expecting a reward for it is like telling a restaurant you won't be ordering dessert and waiting for a larger entree in gratitude. 33. Yo-yo financing got its own item, and now it's time for the delivery day theory. You signed everything yesterday, you want to return the car today, and the dealer's trade-in is already legally theirs because the purchase agreement transferred title the moment you signed it. Title to a vehicle in the United States transfers upon execution of the title document, the physical certificate of title signed by both parties, not upon signing a sales contract. The purchase agreement is a binding contract obligating both parties to complete the transaction. It does not itself transfer vehicle title. Title transfer is a DMV process, recorded by the state agency on a timeline that varies by state, but typically runs within 30 days of the transaction date. In practice, the dealer takes physical possession of the trade-in at delivery and submits the title paperwork for transfer processing within the required window. A deal unwound through mutual rescission before DMV title transfer is recorded is procedurally possible, though the dealer has contractual grounds to decline rescission. The binding contract creates the obligation. The title process records the ownership change. Open lien situations, where the trade-in is still being financed by a bank, mean the lien holder holds the actual title. The dealer requests lien payoff, the bank receives the payment and releases the title, and the transfer processes separately from the sale transaction itself, sometimes taking 10 to 30 days beyond closing. Buyers who have second thoughts after signing have contractual exposure, not title exposure in most cases. And that distinction matters because contractual obligations and title transfer rights are governed by different legal frameworks with different remedies. Signing the purchase agreement binds you to the deal. It does not teleport the title. Whether you can undo the transaction is a contract question, and contracts, once signed by both parties with consideration exchanged, are generally enforceable. 34. The credit inquiry situation has its own item, and now there is a separate but equally confident complaint. Karen provided her social security number to the dealer, but informed them it was conditional, limited, and absolutely not to be used for anything other than the specific purpose she intended, and she is now outraged that it was used for a credit application. The social security number in an automotive lending context is required by lenders to access the three major bureaus, Equifax, Experian, and TransUnion, for a formal credit application. Without it, a complete loan application cannot be processed. Some lenders permit a soft pull pre-qualification using name, address, date of birth, and the last 4 digits. But this produces a pre-qualification estimate, not a loan approval. The Bank Secrecy Act and anti-money laundering regulations require dealers to verify customer identity, including SSN collection via IRS Form 8300 for cash transactions exceeding $10,000, a federal compliance requirement that is not optional regardless of customer preference. Dealers are governed under the Gramm-Leach-Bliley Act to protect financial information and provide privacy notices when SSN is collected. The collection triggers protections, it does not void them. The concern about Social Security number disclosure is identity theft protection, which is entirely legitimate and reasonable. The solution is verifying the dealer's privacy practices and reading the authorization language on the credit application before signing it. Not refusing disclosure and then being surprised that financing cannot proceed. Cash purchases in most scenarios at amounts below the reporting threshold can be completed without SSN in some states. Financed purchases cannot. Refusing to provide your SSN at a dealership is your right. It is also a near certain guarantee that the financing process stops entirely. The number was always what that application required. 35, KBB says $15,000. The dealer offered $11,000 for the trade, and that missing $4,000 is pure theft. A universal lowball applied to every trade-in by every dealer at all times as a baseline extraction strategy. The gap between KBB trade-in value and a dealer's offer reflects real acquisition economics that a private buyer doesn't face and therefore doesn't price for. A dealer purchasing a trade-in faces costs that begin the moment the vehicle arrives. Safety inspection, reconditioning, that may include paint correction, mechanical repairs, and professional detailing. Transportation to auction if the vehicle doesn't fit the dealer's retail inventory profile, auction fees of $300 to over $600 per vehicle if wholesaled, and floor plan carrying costs if the vehicle sits on the retail lot. Wholesale auction pricing, specifically the Mannheim Market Report, and Black Book, is the benchmark dealers use for trade valuations, not KBB. Mannheim data typically runs $1,500 to $3,000 below KBB private party value on common vehicles, reflecting the difference between retail expectation and wholesale market reality. KB trade-in values are also generated from self-assessed condition ratings submitted by the owner, and owner self-assessment consistently skews toward very good or excellent, inflating the output compared to what a trained appraiser observes during a physical inspection. Dealers factor local retail demand into trade offers. A used minivan brought to a performance car dealership has lower utility for that store and will likely be wholesaled, warranting a lower offer than the same vehicle at a family-oriented used car operation. Private party sales on Facebook Marketplace or Craigslist consistently yield $1,500 to $3,000, more than trade-in value for common vehicles in good condition. That difference represents the dealer's reconditioning and resale margin. If you want retail value for your trade, sell it at retail. The two transactions have different economics and have always had different economics. 36. The familiar financial wisdom gets delivered with the full confidence of someone who heard it on a podcast. The second that car crosses the lot line it's used, it's worth 20% less, and you've just lit thousands of dollars on fire through instant depreciation that proves buying new is always a financial mistake. First-year depreciation on new vehicles is real, averages approximately 15 to 25% over 12 months of ownership, and is measured over those 12 months, not at the geographic boundary of the dealership exit. During the 2021 through 2023 vehicle shortage driven by semiconductor supply chain disruptions, numerous new vehicles appreciated in the used market after purchase. A used 2022 Toyota Tacoma was selling above its original MSRP in the open market. The depreciation narrative collapsed entirely under specific supply conditions that defied the conventional model. Depreciation rates vary radically by model in ways that make the universal 20% rule misleading. Toyota Land Cruisers retain approximately 65% of their value after 5 years. Rental fleet domestic sedans may retain 35% over the same period. The vehicles are not in the same depreciation universe, and treating them as though they are produces bad decisions in both directions. The instant depreciation framing is approximately accurate in one narrow sense. If you attempted to wholesale your new car back to a dealer immediately after purchase, you would receive close to trade-in value, which is below what you paid. But that is not depreciation. It is the dealer's resale margin built into the transaction from the start. Certified pre-owned vehicles priced at 1 to 3 years old have already absorbed first-year depreciation in their pricing, which is why they represent a frequently compelling value proposition. Your car did not lose 20% the moment you left the parking lot. The depreciation clock runs on months of ownership, not on geography. 37. Leasing gets dismissed before the conversation starts. It's for suckers, it's throwing money away, you own nothing at the end, and buying is always the smarter financial decision because equity, full stop, end of discussion, as delivered by Karen's brother-in-law, who also gives unsolicited advice about cryptocurrency. The leasing versus buying question is a math problem with multiple variables, not a moral position, and for specific buyers in specific situations, leasing is demonstrably the more economical choice. Leasing makes you pay for only the depreciation that occurs during the lease term plus financing charges, not the total vehicle value. On a vehicle that loses 50% of its value in 3 years, the lease payment is built around that 50% depreciation portion, not the full purchase price. The equity argument against leasing consistently ignores that the equity accumulating in a purchased depreciating asset is frequently less than the total of down payment plus interest paid, particularly on vehicles with aggressive depreciation curves. For business owners and self-employed individuals, lease payments on vehicles used for business are often fully or partially deductible as an operating expense, a tax structure unavailable on purchased vehicles, which require depreciation schedules instead. Luxury and European manufacturers, including BMW and Mercedes, regularly offer manufacturer subreliability or subsidized lease programs with suppressed money factors and elevated residual values, making monthly lease payments on those vehicles dramatically lower than equivalent financing on the same purchase price. A buyer who always wants to drive within the factory warranty window effectively never pays for out-of-warranty repairs under a continuous lease cycle, a real financial advantage on reliability variable vehicles. The correct analysis is total cost of ownership over a defined period, comparing lease total against purchase total, including depreciation, interest, and maintenance. Run the actual numbers for your specific situation before declaring a winner. The principle is sound only if the math is checked first. 38. The warranty negotiation goal is always maximum length. 5 years is good, 10 is better, and whatever the longest available coverage period is, that is the one worth pursuing, because more coverage time is inherently more protection. Warranty length is one variable in a 3-variable coverage equation. The other two, covered components and exclusion language, determine whether the length means anything when a claim is actually filed. Extended warranties are structured as either bumper-to-bumper inclusionary contracts, where everything is covered unless specifically excluded, or stated component exclusionary contracts, where only listed items are covered. The same 10-year term in these two formats produces radically different real-world outcomes. Stated component warranties on used vehicles frequently exclude the most expensive repairs in practice: turbochargers, electronics modules, internal transmission components, and hybrid battery systems. Precisely the items buyers assume they purchase coverage for. A 10-year powertrain warranty that defines powertrain narrowly to exclude seals, gaskets, and associated components triggers less often than the length suggests. Deductible structure matters independently of term. A $200 per visit deductible on a multi-component failure costs $200 total, while a $200 per repair deductible on the same event costs $200 per individual component, potentially $600 to $1,000 for a single service appointment. Warranty transferability. Whether coverage transfers to a subsequent buyer and enhances resale value is a legitimate secondary financial benefit that varies by product and is worth evaluating. Administrator financial stability is more important than term length in determining whether a claim will actually be paid. A 10-year warranty backed by an undercapitalized administrator that becomes insolvent in year 4, a documented pattern in the VSC industry, is worth exactly nothing, regardless of how many years were promised on the brochure. Length without coverage quality is a number attached to a document. Read what the document actually covers before the term becomes the headline. 39. Karen drops off the car for warranty work, waits approximately 6 minutes at the service counter, and then demands a loaner vehicle immediately on the grounds that the warranty is legal proof she's entitled to a free replacement car for the full duration of any repair, no exceptions, no waitlist, right now. Loaner vehicle availability is a manufacturer preemptive program perk, a dealer courtesy policy, or a service contract provision. It is not a universal legal right attached to a warranty repair of any kind. Factory warranties, including bumper-to-bumper and powertrain coverage, typically do not specify loaner vehicle entitlement as a warranty term. Loaners are a dealer-level service decision, not a manufacturer CR mandated warranty benefit that travels with the vehicle. Some manufacturer premium programs, BMW's Ultimate Service Standard, Lexus brand commitments, Cadillac's dealer certification requirements, include loaner entitlement as part of the dealer's brand certification standards. These are customer experience programs established through the manufacturer-dealer franchise agreement, not rights that attach to the warranty document itself. Rental reimbursement a specific dollar per day amount toward rental costs during a covered warranty repair. Is offered by some manufacturers for extended repair situations, particularly when parts delays extend the timeline significantly. This is different from a free loaner vehicle, varies by manufacturer and repair type, and is typically a separate program rather than a base warranty benefit. The Americans with Disabilities Act requires loaner vehicles to be accessible to disabled customers when a loaner program exists, but does not require dealers to operate a loaner program at all. Service contract products sometimes include rental reimbursement as a stated benefit, typically $30 to $50 per day for a maximum number of days, a product feature of that specific contract, not an industry baseline. The warranty covers the repair. The loaner is a hospitality decision that varies by dealer, brand, and situation. Demanding it as a legal right produces a long conversation that ends in the same place as asking. 40. Karen has saved $10,000 specifically to use as a down payment because a larger down payment earns a better interest rate. She read this on a personal finance blog. She has been planning this for 8 months, and she is prepared to leverage that number into a rate she's satisfied with. Down payment size has no direct relationship to the interest rate a lender offers on an auto loan. The rate is determined by the creditworthiness, loan term, vehicle age, and lender-specific risk models applied to the borrower's credit profile, not by how much money is placed down at signing. Lenders determine auto loan rates primarily through credit score as the dominant variable, debt-to-income ratio, loan-to-value ratio, vehicle age and mileage, and loan term length. Loan-to-value ratio, the loan amount relative to the vehicle's value, is the dimension in which down payment has any rate-adjacent relevance. A meaningfully lower LTV achieved through a larger down payment may qualify a borrower for a slightly better rate tier at lenders who use LTV as a secondary risk variable. But this is a secondary factor, not a primary one, and it does not override credit score in any lender's model. A borrower with a 720 credit score putting $1,000 down will typically receive a better rate than a borrower with a 580 credit score putting $10,000 down. The credit score dominance is not overridden by down payment size under any standard lending model. Down payment primarily affects monthly payment amount, total interest paid over the loan term, equity position from day one, and loan approval likelihood for borrowers on the margin of qualification. Dealer finance offices benefit from lower down payments when financing is in-house. More finance principal equals more financing profit potential. Your down payment changes how much you borrow. It does not change what the lender thinks of you. Your credit score established that opinion before you walked through the door. 41. The sophisticated email negotiation strategy is complete. Price confirmed, trade value confirmed, rate discussed, fees itemized, everything in writing, and Karen is arriving just to sign because the hard work is already done and there will be zero deviation from the agreed terms. Email negotiation is an excellent consumer approach. It is not legally equivalent to a signed purchase agreement, and treating it as one creates expectations the finance office will not automatically fulfill without verification at the table. The binding contract is the retail installment sales contract signed in the finance office, not the email thread, however detailed, that preceded it. F&I product presentation is legally required to be conducted in person under most state dealer regulations. The finance manager must present products, the buyer must acknowledge them, and signature lines confirm acceptance or declination. This process cannot be eliminated by email pre-negotiation because the regulatory requirement is transactional, not informational. The vehicle price, trade value, and OTD figure confirmed in an email should transfer directly to the final contract, and discrepancies are both detectable and contestable when you have the email record to compare against. Tax and registration estimates in pre-sale emails may differ from final DMV calculations by small amounts, which are not a breach of the agreed terms. Internet sales managers who handle the email negotiation have pricing authority comparable to floor managers at most stores, but their confirmed pricing is typically contingent on the specific VIN being available and in the same condition at time of delivery. Vehicles agreed upon by email have been sold to in-person buyers who arrive first, a genuinely frustrating occurrence that email agreement does not legally prevent. The correct execution is arriving with the email printed, reviewing each line of the final contract against the confirmed figures before signing, and flagging any discrepancy before the pen touches the document. Groundwork is excellent. It is not a substitute for reading the actual contract. 42. Karen is returning the car. She's had it for 11 days. She doesn't want it anymore. And the dealer, she informs everyone within earshot, can legally take it back because you have 3 days in California, or maybe it's 30 days, the number shifts slightly with each retelling, and the dealer is breaking the law by refusing to process the return. There is no universal car return window in California or any other state for standard dealership purchases. California's contract cancellation option, the mechanism closest to what Karen is describing, is a paid add-on that dealers may optionally offer, allowing the buyer to purchase a 2-day cancellation right at signing for a fee. Dealers are not required to offer it. Most don't. If it was not presented, purchased, and documented in the original contract, it does not exist for this transaction regardless of what was read online. The FTC's cooling off rule, discussed earlier, explicitly excludes dealership showroom sales from its 3-day cancellation provision. Standard vehicle purchases become binding transactions in all 50 states the moment the contract is executed and the vehicle leaves the lot. A dealer who accepts a return after 11 days is exercising business discretion, not fulfilling a legal obligation. The practical landscape for a buyer who genuinely wants to return a vehicle is mutual rescission by dealer agreement, lemon law eligibility if the vehicle has a substantial covered defect with a documented repair history, or civil action for fraud if the dealer made material misrepresentations that induce the purchase. None of these is a no questions asked 11-day return window. If the dealer agrees to take the car back, it is a courtesy. If they decline, they are not violating any law. The transaction was complete when you drove away. 11 days of ownership and a change of heart is not a legal basis for return in any jurisdiction. 43. Karen spots a used car listed at a price and decides the dealer bought it for roughly that number minus 15%, giving her a precise margin to negotiate against. Confident in her cost structure analysis and ready to present her counter with supporting rationale. Used vehicle retail pricing does not follow a uniform cost plus margin formula, and anchoring your negotiation to a percentage assumption that has no consistent relationship to actual acquisition cost is strategy built on a model that describes none of the vehicles on this lot. Dealers acquire used vehicles through trade-ins, lease returns, wholesale auction, and direct individual purchase, each channel producing a different acquisition cost for vehicles that may appear identical on the lot. Auction acquisition adds buyer fees of $300 to over $600, transport costs, and arbitration risk. A clean trade-in acquired for $8,000 and an auction vehicle of the same year, make, and model acquired for $11,000 may be retailed at the same sticker price if current market data supports it. The sticker reflects the market, not the acquisition. Reconditioning costs, mechanical repairs, cosmetic work, detailing, safety inspection, applied before pricing range from a few $100s on a clean vehicle to over $3,000 on high mileage inventory with deferred maintenance. These costs are added to acquisition before pricing, but are invisible to the buyer. Dealers use live market tools, including Vauto and CarGurus market analysis, to price based on competitive local listings and days on market velocity. A vehicle sitting on day 40 may be priced lower than an identical vehicle on day 3 because the tool is flagging market age. The gross profit on used vehicles averages $2,000 to $3,000 per unit front end per NADA data, higher than new vehicles because the pricing variability creates real negotiating range. Bring a current competitive listing comparison, not a fixed percentage. That's what the dealer is looking at. 44, the finance office appears, and Karen takes her seat with a prepared statement. She wants the lowest interest rate available, the finance manager is legally required to provide it, and anything withheld is fraudulent concealment of information she's entitled to as a consumer. The finance manager is not legally required to give you the lowest rate available. The specific mechanism Karen is objecting to is called dealer reserve, and it is a legal, regulated, and explicitly reviewed profit structure that the CFPB has studied in detail, published guidance on, and declined to prohibit under current federal law. The dealer buys a loan at the lender's buy rate, established by the lender based on your credit profile, and sells it to you at a higher rate, retaining the spread as income. On a $35,000 loan at a 2% markup over 60 months, that reserve approximates $2,200 in profit that never appears as a line item. The CFPB's 2013 guidance attempted to address discriminatory application of rate markup and was overturned by Congress in 2018. The rate is not the lowest available. The disclosure of that fact is not required by any current federal statute. What is required is that the APR be clearly disclosed on the contract, which it is. The consumer protection mechanism is not a legal demand for the rate sheet. It is arriving with a pre-approved competing offer from a bank or credit union which establishes your rate ceiling and forces the finance office to compete or lose the financing income entirely. Manufacturer subvented rates, 0% for 36 months, 1.9% for 60 months, are the lowest available and are disclosed because they function as sales incentives, not because disclosure is mandated for all rates, come with a competing rate. That is the actual lever. A legal demand for the full rate sheet will produce a polite explanation that no such requirement exists. 45. The trade-in value and the vehicle purchase price are being negotiated separately as instructed by the strategy video, and Karen is certain she has isolated the variables successfully. The car is locked at $38,000, the trade is locked at $12,000, and the net cost is $26,000 no matter what happens next in the finance office. The net cost on the contract is not $26,000. Separating the negotiation conversations does not prevent the deal structure from being viewed holistically by the desk manager, who is looking at total gross profit across all variables simultaneously. This is not a conspiracy. It is how deal management software works. MaximTrack, DealerSocket, and equivalent desking platforms display all deal variables in real time and optimize structure to maintain target gross profit. A concession on trade value may be accompanied by reduced flexibility on the vehicle price. An apparent generosity on the vehicle may be offset in dealer fees. The integrated contract is what binds, not the separate conversational agreements that preceded it. The correct protection is verifying the final contract against each agreed figure independently before signing. If the vehicle was negotiated to $38,000, that number should appear on the contract at $38,000. If the trade was agreed at $12,000, that credit should appear at $12,000. If either number changed between the negotiation and the contract, you have the written record of what was agreed and a documentable discrepancy to address before signing. The four-square method, the physical paper divided into purchase price, trade value, down payment, and monthly payment, was designed specifically in the 1980s to allow flexible manipulation of all four simultaneously in ways that obscure the actual economics. Your defense is the out-the-door total measured against what you agreed, not the separateness of conversations that the dealer's software never treated as separate. 46. Karen has confirmed that the manufacturer's bumper-to-bumper warranty covers everything between the bumpers, no exceptions, and she expects any issue that arises during the coverage period to be processed as a warranty claim without question, because that is what bumper-to-bumper means by definition. Bumper-to-bumper is a marketing phrase coined to communicate broad coverage in contrast to narrow powertrain-only warranties. It is not an engineering specification, and every factory warranty carries documented exclusions that remove significant component categories from coverage regardless of where those components sit relative to the bumpers. Universal exclusions across all manufacturer warranties include wear items, brake pads and rotors worn through normal use, wiper blades, tires, filters, belts, clutch friction material, one freeze, and maintenance items including oil, fluids, and alignment adjustments. Tires on a new vehicle are covered by the tire manufacturer's separate warranty, typically 4 years with limited mileage provisions, not by the vehicle manufacturer's warranty. Discovering a tire defect and approaching the car dealer expecting a warranty claim is the first sign that the warranty booklet was not read. Corrosion warranties sound comprehensive and typically cover only perforation from the inside out, rust penetrating through the metal panel, not surface rust or cosmetic oxidation. Emissions warranties, federally mandated at minimum 2 years and 24,000 miles in California standard states, cover specific emissions-related components and are a separate warranty from bumper-to-bumper that most buyers are unaware exists. EV and hybrid traction battery warranties, federally mandated at 8 years and 100,000 miles, minimum defined capacity degradation thresholds. A battery at 79% capacity is not covered under a warranty protecting down to 70%. The threshold number is everything. Warranty claim denial based on lack of maintenance records requires the dealer to prove neglect, cause the failure under Magnuson-Moss Act protections. Bumper-to-bumper does not mean everything. It means everything that isn't excluded. The exclusion list is in the warranty booklet that came in the glove compartment. 47. The competitor's advertisement gets placed on the desk. Same vehicle, lower price, printed, and brought in as leverage. And Karen informs the sales manager that they are legally required to match it because price match guarantees are a universal dealership policy she has seen work at electronics retailers, and the principal transfers directly. No automotive dealer is legally required to match a competitor's price. Price matching is a voluntary retail policy tool, a marketing differentiator that some dealer groups adopt by choice and that no consumer protection law, FTC regulation, or state motor vehicle statute mandates. The vehicle comparison required to execute a price match is inherently more complex than the electronics retailer scenario Karen is referencing because no two used vehicles are identical. VIN-specific differences in options, condition, history, and dealer add-ons mean that comparing two vehicles listed at different prices requires analysis beyond the sticker number. New vehicles at different dealers may carry different manufacturer-installed packages, different dealer add-ons, and different fee structures, making the advertised price comparison incomplete as presented. Competitor advertised prices frequently include rebates the buyer may not qualify for, creating an apparent price mismatch that reflects rebate eligibility rather than dealer margin. Some dealer groups, including AutoNation, have advertised specific price match policies as brand commitments. These are voluntary marketing tools, not legal obligations, and they contain their own qualifying conditions. Presenting a competitor's price as negotiating leverage is a legitimate tactic that dealers may choose to respond to. A dealer who matches a competitor's vehicle line item price may recapture the difference through dealer fees, finance office products, or trade-in adjustment. The total deal is what requires comparison, not the vehicle price in isolation. Electronics retailers match identical products with identical part numbers. Cars have VINs. The comparison breaks down the moment two vehicles with different histories and different conditions get treated as interchangeable units. 48, the parking lot conversation happened, and it was unambiguous. The salesperson said the car came with free oil changes for life, said it in the parking lot, said it clearly, and Karen is now in the finance office with a lawyer's understanding of verbal contract formation and a demand that the promise be honored immediately. The parole evidence rule is one of the foundational principles of contract law, codified across state jurisdictions and applicable to goods contracts under UCC provisions, and it establishes that prior or contemporaneous verbal statements that contradict or supplement a fully integrated written contract are generally not admissible to modify the contract's terms. The retail installment sales contract is typically drafted as an integrated agreement with merger language, stating it represents the complete agreement between the parties. Free oil changes for life, floor mats, a cargo cover, a second set of keys, these are all verbal representations with zero legal enforceability if they do not appear in the signed document. The parking lot conversation was marketing. It was enthusiasm. It was the kind of thing people say in the middle of a sales process that has no legal weight the moment a different document is signed by both parties. The Magnuson-Moss Warranty Act provides a narrow exception. Verbal warranty representations made during sale may be enforceable as implied warranties under specific conditions that require factual development. This is a narrow legal theory that requires analysis by a consumer attorney, not a self-help argument made at the finance office counter. The practical consumer protection is a single sentence applied before signing. Put it in writing. Any verbal promise that affects the deal's value must be added to the purchase agreement as a written addendum with both parties' initials before you sign the main document. That addendum takes 3 minutes to produce. Signing without it and arguing afterward takes considerably longer and succeeds less often. 49. Karen achieved invoice price on a new vehicle, left the dealership, and has been telling everyone since that she paid exactly what the dealer paid. They made nothing, she got the car at cost, and the negotiation was a complete victory over a system designed to extract as much money as possible from uninformed buyers. Invoice price is a published number. It is not the dealer's actual cost. The distinction matters because the myth of the zero-profit invoice deal produces a false ceiling on what a buyer thinks is achievable and a false floor on what they think the dealer needs. Below the invoice price sits holdback, a percentage of MSRP, typically 1 to 3% depending on manufacturer, paid quarterly from the manufacturer to the dealer after the sale, regardless of what negotiated price was achieved. On a $40,000 MSRP vehicle at 2% holdback, $800 returns to the dealer after you've driven away. Dealer cash, manufacturer to dealer incentive separate from consumer rebates, may add $500 to $3,000 or more on slow-moving models, invisible to the buyer and stacked on top of holdback. Invoice price itself includes a wholesale margin built into the manufacturer's pricing architecture. It is not manufacturing cost or dealer break-even. The theoretical zero-profit front-end scenario exists primarily on high-demand vehicles where no dealer incentives are available, which is a minority of inventory. Finance office income, rate reserve and product sales, represents profit earned independently of vehicle front-end gross. A deal at invoice with strong F&I production is a profitable deal. Service lane capture, the value of that customer returning for paid maintenance and repairs over the vehicle's lifetime, is factored into franchise economics as long-term revenue. You got a good deal. You did not break even for them. The holdback check arrives at the dealer's door 90 days after you left theirs. 50, the nitrogen-filled tire upsell arrives, and Karen's response is immediate. You want $200 to put air in my tires? Air is already 78% nitrogen. You are selling me something I already have. And this is the textbook definition of fraud. The science behind nitrogen tire inflation is real. The dealer's pricing is inflated. These are two separate facts that are being combined into one wrong conclusion, and the conclusion costs you more than either fact individually. Standard atmospheric air is approximately 78% nitrogen, 21% oxygen, and 1% other gases. Nitrogen tire filling replaces the oxygen and moisture content with nitrogen at a concentration of 95% or above. Oxygen molecules are smaller than nitrogen molecules and permeate tire rubber faster, a measurable physical difference that produces a documented effect on pressure retention. NASA uses nitrogen in aircraft tires. Aviation and motorsport industries use it for pressure stability under load and temperature variation. The practical benefit in passenger vehicle use is modest. Nitrogen-filled tires maintain pressure approximately 2 to 3 times longer between top-offs than air-filled tires, according to published research in the journal Rubber Chemistry and Technology. Temperature sensitivity is the relevant variable. Oxygen-filled tires gain approximately 1 psi for every 10 degrees Fahrenheit of temperature increase. Nitrogen shows measurably reduced pressure variation across temperature changes, with modest implications for tire wear and fuel efficiency over time. Consumer Reports has characterized nitrogen's passenger vehicle benefits as marginal, real but unlikely to be perceptible to average drivers under typical conditions. The dealer's charge of $150 to $250 is a significant markup over the actual service cost of $5 to $10 per tire at a specialty shop. The product is not a scam. The price is padded. These are different complaints. Refusing the product entirely because the price is wrong means you've conflated the two. 51. The purchase is complete, the trade-in is gone, and then the second thoughts arrive. And Karen calls to inform the dealer that she needs the trade-in returned because the purchase agreement did not transfer legal title, and therefore the car is still hers until the DMV processes something. Title to a vehicle transfers upon execution of the title document, the physical certificate of title signed by the seller, not upon signing a sales contract at the dealership. The purchase agreement creates a binding contractual obligation. It is not itself a title transfer instrument. Title transfer is a state agency process recorded by the DMV on a timeline that varies by state but typically runs within 30 days of the transaction date after the dealer submits the paperwork. In practice, the dealer takes physical possession of the trade-in at time of delivery and initiates title transfer within the required statutory window. The vehicle is physically in the dealer's possession. The title transfer is processing. These are two separate things happening simultaneously, and neither of them gives you a legal basis to demand the car back. If the deal is being unwound by mutual agreement of both parties before DMV recording, returning the trade is procedurally possible. But the dealer has full contractual grounds to decline rescission because the purchase agreement they signed is a binding contract with consideration exchanged. Open line situations complicate the timeline further. If the trade-in was still financed, the lien holder holds the actual title, and the dealer requested a payoff that may take 10 to 30 days to process before the title is released and transferred. That process runs independently of your decision to reconsider the transaction. Signing the purchase agreement bound you to the deal. The title paperwork is on a separate clock. Whether you can legally undo the transaction is a contract question governed by contract law. And signed contracts with consideration exchanged are binding. 52. Karen has identified the problem. Every dealership employee is trained to lie. compensated for deceiving customers, and the entire institution operates as an organized deception enterprise where no statement from any employee can be trusted under any circumstances. This framing converts a real, documented industry problem into a conspiracy theory broad enough to be useless as actual consumer protection. Dealer salespeople in most states are licensed through motor vehicle dealer licensing boards that require background checks, training, and ongoing compliance. License revocation for deceptive practices is an active enforcement mechanism with documented case history. The FTC's CARS rule, effective 2024, imposes specific disclosure requirements with personal liability, implications for individual dealership employees, not just the corporate entity. Dealer management systems, including Reynolds and CDK Global, create detailed audit trails of every transaction. Documentation that exposes deception rather than concealing it, because every deal is recorded with timestamps and approval histories. Customer satisfaction scores, CSI ratings, directly affect manufacturer-dealer agreements, vehicle allocation priorities, and co-op advertising eligibility. A dealership with systemic deception loses allocation and brand standing, which are worth far more than the short-term profit from any individual deceptive transaction. Sales staff turnover in automotive retail averages 67% annually per INATA workforce data. Many salespeople actively leave the industry specifically because high-pressure cultures conflict with their professional preferences. The FTC's 2023 Operation Steer Clear enforcement sweep resulted in actions against 19 specific dealerships for documented deceptive practices. Targeted, evidence-based enforcement against bad actors, not evidence of industry-wide criminality. The industry has genuine structural problems and documented bad actors. Treating every employee in every dealership as a coordinated liar makes you equally wrong about everything and protected from nothing. Specific documented deception is worth pursuing. A blanket conspiracy framework just makes you the customer nobody can help. 53. Karen's CPO vehicle has a prior accident on the Carfax, and she is filing a lawsuit because the dealer concealed the accident history, was legally required to disclose it before sale, and the certified pre-owned designation means the vehicle should have a spotless record that this accident history violates. Federal disclosure requirements and state dealer statutes do not universally require dealers to volunteer accident history for vehicles with clean titles. This is the specific gap that buyers consistently misunderstand when they believe certification guarantees a transparent history. Title branding, salvage, rebuilt, flood, is mandatory disclosure in all 50 states and follows the vehicle permanently on the title. These are statutory categories that trigger unavoidable disclosure obligations. Accidents that were repaired without triggering a total loss declaration, without insurance involvement, and without a title brand may not appear on any required disclosure document and are not universally required to be volunteered by the dealer. Carfax compiles data from insurance companies, DMV records, auction reports, and participating service facilities. An accident resolved through cash repair without an insurance claim may not appear on any third-party history report and is not in the dealer's records if it predates their acquisition of the vehicle. CPO programs explicitly accept vehicles with repaired prior damage in most manufacturer programs, provided the repair meets current manufacturer standards. The CPO status certifies the inspection and reconditioning outcome, not the absence of prior incidents. Some states have more expansive dealer disclosure requirements for material defects. California, New York, and Texas each have variations. Whether a properly repaired prior accident qualifies as a material defect requiring disclosure is a legal question with jurisdiction-specific answers. The correct pre-purchase protection is running both Carfax and AutoCheck, which use different databases, and conducting an independent mechanical inspection. These tools exist specifically because disclosure requirements do not cover everything you want to know. 54. The pre-purchase inspection is unnecessary because Karen can tell a good car when she sees one. It looked clean, it drove normally on the 15-minute test drive around the block, and she has good instincts from years of driving that are more reliable than paying $100 for a stranger to look at something she already evaluated herself. Visual inspection and a brief test drive detect surface-level condition and obvious drivability failures. They are structurally incapable of identifying the failure modes that produce the most expensive post-purchase surprises, because those failure modes produce no visible surface symptoms and minimal perceptible driving characteristics in their early to moderate stages. Transmission slip progression, oil consumption through worn piston rings, cooling system seal failure, timing chain wear, strut bearing deterioration. These do not announce themselves on a 15-minute neighborhood drive. Pre-purchase inspections conducted by independent mechanics using a lift detect frame damage, subframe rust, fluid leaks, CV boot condition, brake wear depth, exhaust system integrity, and suspension component wear, none of which are visible at curb height or detectable on a brief evaluation drive. An OBD2 scanner reading of stored and pending fault codes, a 2-minute process using a $30 Bluetooth device, reveals developing issues that have not yet triggered a check engine light. Sellers routinely clear stored codes before a sale. Pending codes reappear within drive cycles and would be visible to a technician who checked them. Compression testing and coolant system pressure testing reveal combustion chamber wear and head gasket integrity. Repairs that run $2,000 to $6,000 and are functionally invisible during a test drive, regardless of how experienced the driver is. Consumer Reports data shows buyers who skipped pre-purchase inspection report significantly higher rates of unexpected major repairs in the first year of ownership. A pre-purchase inspection costs $100 to $150. The car you're evaluating costs $20,000. Those are not comparable risks to balance against instinct. 55. Karen negotiated the vehicle to invoice price, drove home satisfied, and has been confidently telling everyone that the dealer made absolutely nothing on the deal. She paid what they paid, they broke even, and she won the negotiation completely. Invoice price is a published document number. It is not the dealer's actual cost, and the gap between those two things is where the confidence collapses. Dealer holdback is a percentage of MSRP, typically 1 to 3% depending on manufacturer, paid quarterly from the manufacturer to the dealer after the sale closes, regardless of what negotiated price was achieved on the showroom floor. On a $40,000 MSRP vehicle at 2% holdback, $800 returns to the dealer after you've driven away feeling victorious. Dealer cash, manufacturer to dealer incentive payments, separate from any consumer rebate. May add $500 to over $3,000 on slow-moving models, invisible to the buyer, stacked on top of holdback, and never appearing on any customer-facing document. The invoice price itself includes a wholesale margin built into the manufacturer's pricing architecture. It is not manufacturing cost, it is not break-even. It is a published intermediate number between manufacturing cost and MSRP that was never designed to represent what the dealer actually paid. The true zero-profit front-end scenario exists primarily on high-demand vehicles where manufacturer incentives are not available, a minority of inventory in any given month. Finance office income from rate reserve and product sales represents profit earned completely independently of vehicle front-end gross. A deal closed at invoice with productive FI performance is a profitable deal by any measure. Long-term service lane revenue from that customer returning for maintenance and repairs is factored into franchise economics as a revenue stream that outlasts the transaction by years. You got a good deal. You did not break even for them. Their holdback check arrives 90 days after you left the lot. 56. Karen is refusing the red car because she read that red vehicles carry higher insurance premiums. Everyone knows red cars get more speeding tickets. Insurers know it too, and choosing a red vehicle is a financial decision she has already calculated the long-term cost of and decided against. Vehicle color has no effect on insurance premiums. This is not a nuanced statement with exceptions and edge cases. It is a clean, flat fact confirmed by every major insurer operating in the United States. State Farm, Geico, Progressive, Allstate, and USAA rate vehicle insurance on year, make, model, trim level, engine size, vehicle age, driver's driving record, credit score in states that permit it, garaging location, annual mileage, and safety and anti-theft features. Color is not a variable in any of these models. Insurance rating manuals are filed with and approved by state insurance commissioners as part of the regulatory oversight process. Regulators would identify and reject a rating factor as arbitrary and discriminatory if it were proposed. The Insurance Information Institute, the industry's primary research organization, has explicitly stated on multiple occasions that color does not affect insurance rates. The premise underlying the myth that red cars receive more speeding citations has been tested against traffic stop data and shows no statistically significant over-representation of red vehicles in speeding enforcement when adjusted for the proportion of red vehicles in the overall fleet. The myth likely originated from the anecdotal association of red paint with performance vehicles, sports cars and muscle cars that are statistically ticketed more often. The vehicle type and the driver profile attached to it drive the insurance cost and the enforcement pattern. The color is irrelevant to both. What actually affects your premium, specific model theft rates, IIHS and NHTSA safety ratings, and repair cost data for your specific trim. Your red car does not know it is red, neither does your insurer. 57. The announcement lands before the finance manager has taken his seat. Karen is a cash buyer, she has the full amount ready, and she expects a meaningful discount in recognition of the fact that cash is king, cash is simple, cash saves everyone time and processing fees, and cash buyers have always received preferential pricing as a matter of industry custom. Cash purchases produce less total revenue for the dealership than finance purchases because the dealer earns no financing profit from a cash transaction, and financing profit is one of the primary income streams in automotive retail. A financed vehicle purchase generates dealer income from the vehicle front-end gross and from finance reserve. The rate markup retained when a loan is sold to a lender at a higher rate than the dealer paid. A cash purchase generates only the front-end vehicle gross. On a $40,000 vehicle financed at a 2% rate markup over 60 months, dealer finance reserve approximates $2,200 in income that a cash deal produces exactly zero of. Dealer finance departments track penetration rate, the percentage of deals financed through the store, as a performance metric that affects how the department is evaluated internally. Cash deals reduce that metric without providing offsetting financial compensation. The fee savings from cash are negligible. Credit card interchange fees of 2 to 3% are already limited or refused on large automotive transactions, and bank check processing costs nothing material. Manufacturer rebate programs frequently require dealer-arranged financing for specific terms to unlock the full incentive amount, meaning cash buyers may qualify for smaller total rebates than finance buyers on the same vehicle. Announcing you're a cash buyer and expecting a discount for it is like declining dessert at a restaurant and waiting for the kitchen to increase the size of your entree in gratitude. The math works in the opposite direction from what the announcement assumes. 58. The service advisor has recommended a transmission fluid exchange, a brake fluid service, and a cabin air filter replacement. And Karen is certain every one of these is manufactured on the spot specifically to inflate her bill. The car runs fine, she drove it here without incident, and service departments invent needs that don't exist as a matter of standard operating procedure. Unnecessary service recommendations are a real and documented problem in automotive retail across both independent shops and franchise dealerships. A 2013 COA study found that approximately 1/3 of U.S. drivers have experienced unfair or dishonest treatment at automotive service facilities. Across shop types, not exclusively at dealerships. The problem is real. The conclusion that every recommendation is invented is not. Manufacturer service manuals specify maintenance intervals for transmission fluid, brake fluid, coolant exchange, and other items based on engineering data about fluid degradation over time and mileage. A service advisor recommending these at their manufacturer's specified interval is following documented guidance, not generating revenue from thin air. Cabin air filters, engine air filters, and wiper blades have short inspection cycles and are frequently overdue at standard service appointments. Recommending them is statistically accurate more often than it is opportunistic. Service advisors are compensated on effective labor rate and parts sales, which creates a structural conflict of interest that is real and worth acknowledging. The consumer protection tool is straightforward. Ask to see the evidence before authorizing any recommended service. Show me the dirty filter. Show me the brake pad measurement. Show me the fluid sample. A legitimate recommendation survives that request without difficulty. Manufacturer customer service lines will confirm whether a recommended service appears in the maintenance schedule for your specific mileage. A verification resource available to every customer and used by almost none of them. Some recommendations are manufactured, most come from a schedule. The ones in between require 15 seconds of evidence. 59. Karen has located a competitor's lower price, brought it to the dealer, and is now demanding a price match on the basis that price match guarantees are a universal retail policy that all businesses honor, that she has seen it work at electronics retailers, and that the dealer is obligated to meet the competitor's number or explain in writing why they won't. No automotive dealer is legally required to match a competitor's price. Price matching is a voluntary marketing tool adopted by some retailers by choice. No consumer protection law, FTC regulation, or state motor vehicle statute requires it. Some dealer groups, including AutoNation, have adopted explicit price match policies, as voluntary brand commitments with their own qualifying conditions. Business decisions, not legal obligations. The vehicle comparison required to execute a meaningful price match is more complex than the electronics scenario Karen is referencing because no two used vehicles are identical. VIN-specific differences in condition, history, options, and dealer reconditioning mean that two vehicles with the same year, make, model, and trim description may be genuinely different products at different price points for documented reasons. New vehicles at competing dealers may carry different manufacturer-installed options, different dealer add-on packages, and different fee structures, making the sticker comparison incomplete without a full itemized analysis of both deals. Competitor advertised prices frequently include rebates the buyer may not qualify for, producing an apparent price gap that reflects eligibility rather than dealer margin. Presenting a competitor's price as leverage is a legitimate negotiating tactic. Dealers may choose to respond to it, meet it, or decline based on their own pricing model and margin position. A dealer who matches a vehicle line item price may recapture the difference through fees, financing, or trade-in adjustment. The full deal is what requires comparison. Electronics retailers match identical products with identical part numbers. Cars have VINs. The scenario breaks down at that distinction. 60. Karen has decided to tell everyone loudly and at significant volume because she believes the social pressure of a visible confrontation will force the dealership to offer a better deal. Other customers will witness the exchange, management will want the disruption to stop, and the path of least resistance is a price concession. Loud confrontational behavior in dealership showrooms is so common that it is a trained against scenario in every management development program in the industry. Reynolds University, NADA Academy, and Joe Verdi Group all include specific modules on handling escalating customer behavior, covering de-escalation technique, deal protection under pressure, and trespass procedures for situations that cross the line from difficult to disruptive. Other customers observing a confrontation are statistically more likely to reconsider their own purchase than to conclude the complaining buyer is making valid points. The social dynamic works against the complainer, not for them. High-volume dealerships process multiple transactions daily. One upset customer in the showroom creates minimal operational disruption to a business running 8 other deals simultaneously. The assumption that management will absorb a financial loss to restore a social environment underestimates how many times that specific calculation has already been made and rejected. Genuine negotiating leverage comes from 2 sources: information, knowing current market pricing, having competing offers in hand, and mobility, the actual demonstrated willingness to leave and purchase elsewhere. Neither of these is produced by volume. State Attorney General Consumer Protection Divisions, the CFPB complaint portal, Google reviews, and BBB complaints create real lasting business consequences that a showroom scene does not. Buyers who remain calm, document everything in writing, and reference specific regulatory provisions consistently produce better outcomes than confrontational buyers in every documented study of automotive negotiation. The leverage is in the competing offer in your email. Volume is not a currency that buys anything at a car dealership. 61. The open recall is discovered, and Karen announces this dealer is breaking federal law by offering the vehicle for sale. She intends to contact NHTSA, the FTC, and possibly elected officials before the day is over, because selling a car with an open recall is an illegal act she is prepared to document and report. Federal law prohibits dealers from selling new vehicles with open safety recalls. That same prohibition does not apply to used vehicles, and the distinction is specific, documented, and entirely legal under current federal statute. The FAST Act of 2015 prohibits rental car companies from renting vehicles with open safety recalls. It does not extend that prohibition to used vehicle sales at franchised or independent dealerships. New vehicle sales with open recalls are prohibited under the National Traffic and Motor Vehicle Safety Act. Dealers must complete recall repairs before delivering a new vehicle to a retail buyer. Used vehicles are explicitly outside that prohibition, and a franchise dealer can legally sell a used car with an open recall. In most states provided applicable disclosure, requirements are met, which vary by jurisdiction. California has proposed but not enacted comprehensive restrictions on used car recall sales. Most states have no such law. CarMax adopted a voluntary policy of completing open recalls before retailing used vehicles in 2015, a business differentiator that generated positive consumer coverage, not a legal requirement for the industry. NHTSA's public VIN lookup tool at nhtsa.gov .gov allows any buyer to check open recalls on any vehicle in under 60 seconds using only the number on the dashboard. This tool exists and is free and requires no registration. The dealer isn't breaking the law. The law has a specific gap in used vehicle coverage that is worth knowing before you buy, not after. Check the VIN before you sign, not after you've called the congressman. 62. Karen pulls up one pricing website on her phone, gets a number, and declares that figure the final, scientifically established, legally valid market value of the vehicle. Any deviation from it is fraud, and the fact that 3 other websites show different numbers is proof those websites are wrong, rather than proof that the methodology varies. Vehicle valuation is a modeled estimate produced by algorithms with different data sources, different geographic weighting, and different condition assessment inputs. No single website produces a legally binding market value for any specific vehicle. Kelley Blue Book, Edmunds True Market Value, Day Guides, Black Book, and Mannheim Market Report each use different methodologies and regularly produce values for the same vehicle that differ by $1,500 to $3,000. Not because one is right and the others are wrong, but because they are modeling different things with different inputs. KBB consumer-facing values reflect buyer retail price expectations. Edmunds TMV is calculated from actual transaction data and adjusts by region, making it generally closer to real transaction prices on new vehicles. Condition grades submitted through consumer valuation tools are self-assessed by the owner entering the query, and owner self-assessment on vehicle condition consistently skews toward very good or excellent, inflating the output above what a trained appraiser would assign after physical inspection. Regional demand produces genuine price variation. The same truck trim in 2 different metro markets may trade at a $2,000 to $4,000 spread, reflecting local inventory levels, fuel cost sensitivity, and seasonal demand patterns. True market value for any specific vehicle in any market on a specific day is what a willing buyer pays a willing seller in that transaction. An aggregate that valuation websites model but do not determine and cannot enforce. A pricing website is a weather forecast. It is a model's calibrated estimate. The actual price of this car today is what someone will pay for it, and that number has never existed on any website. 63. Karen is certain that because she confirmed the price by email, has the exchange in writing, and the salesperson responded with an exact figure. The deal is done, locked, and any deviation in the finance office is a breach of the written agreement she is prepared to enforce in small claims court if necessary. Email price agreement establishes a strong good faith basis for the negotiation. It is not a binding purchase contract. The binding contract is the retail installment sales contract executed in the finance office, the document that determines the actual legal terms of the transaction. Prior email exchanges are evidence of the negotiation that preceded the contract, not substitutes for it. F&I product presentation is a legally required in-person process under most state dealer regulations. The finance manager must present products, you must acknowledge each one, and signature lines confirm your decision. This cannot be pre-completed through email because the regulatory requirement is transactional and documented at the point of signature. The vehicle price, trade-in credit, and out-the-door total confirmed in an email should appear on the final contract. And if they don't, the email record is precisely the documentation you need to identify the discrepancy and require correction before signing. Tax and registration estimates in pre-sale email communications may differ from final DMV calculations by small amounts that do not represent a breach of agreed terms. Internet sales managers have pricing authority comparable to floor managers at most stores, but their pricing is contingent on the specific VIN being available and unchanged at time of delivery. A vehicle agreed upon by email has been sold to an in-person buyer who arrived first. An email agreement does not legally prevent that outcome. Bring the email. Compare every line on the final contract against it before signing. The email is excellent groundwork. The contract is the law. 64. The finance manager presents an interest rate and Karen rejects it automatically. Her policy is to refuse the first rate offered because it is always the worst available, and refusal always produces a better number, and she is not leaving this office until a lower rate appears on the screen. Reflexive rejection of a rate offer without a competing benchmark is not negotiation. It is theater that the finance manager has a trained response to. The rate presented in the finance office is sourced from a panel of lenders whose offers are determined by the buyer's credit profile, not by the finance manager's opening disposition. Captive lenders subvented rates, manufacturer financing programs offering 0% APR for 36 months or 1.9% for 60 months, are promotional offers set by the manufacturer's finance arm. They cannot be negotiated lower by the dealer because the dealer is not the one who set them. If a subvented rate is the best available for your credit profile and purchase, that is the number. A buyer with a pre-approved competing rate from a credit union creates genuine competitive pressure that may produce a rate reduction, because the dealer's finance office must match or beat it to retain the financing income. A buyer who simply says the rate is too high without a competing offer has produced a conversational stalemate that resolves in one of two ways: a small adjustment to appear responsive, or an explanation that the rate reflects the lender's decision on the credit file. The rate markup, dealer reserve, is where legitimate negotiation exists. Asking specifically for a reduction in the dealer's reserve to produce a lower presented rate is the precise request, not a general rejection of the figure on the screen. Bring a competing rate from your credit union, that is the actual lever. Refusing on principle without a number to negotiate against is confidence applied to nothing. 65. Karen has arrived to inform the dealer that she is entitled to every rebate and incentive she qualifies for, and that withholding any of them constitutes fraud. She has heard there are the hidden rebates, the dealer pockets them, and she wants full disclosure of every program applicable to her purchase before proceeding. Consumer rebates belong to the buyer. Dealer incentives are a separate business subsidy paid from manufacturer to dealer that has never been the buyer's money. These are two distinct programs that the myth consistently conflates into one imagined concealment. Manufacturer-consumer rebates, cash-back offers, are publicly advertised on manufacturer websites, Edmunds, and KBB monthly. They are applied to reduce the purchase price or paid as cash at closing, and concealing an applicable consumer rebate while pricing above it is a deceptive practice the FTC has addressed in enforcement actions. Dealer cash, manufacturer to dealer incentive, is a payment from the manufacturer to the dealer business as compensation for promoting specific models, maintaining inventory levels, or hitting volume targets. Dealers are not required to disclose these amounts and are not required to pass them along to buyers because they are not buyer money. They are a business-to-business subsidy analogous to a supplier giving a retailer a promotional allowance. The amounts and approximate values of current dealer cash programs are published monthly in Edmunds and Automotive News for industry observers. They are not secrets, just not consumer-facing disclosures. Buyers who negotiate using Edmunds TMV data are implicitly capturing some of the value created by dealer incentive money because TMV reflects actual transaction prices influenced by dealer willingness to discount against incentive-funded margins. Consumer rebates are on the manufacturer's website right now. Research them before you arrive. What the dealer retains as business subsidy is not your money being intercepted. Know the difference between the two programs before you arrive with the fraud allegation. 66. The dealer service department has recommended a repair and Karen wants the part at dealer cost because she's going to install it herself. She won't be using their labor, and charging retail on a part to someone doing their own work is a markup she finds personally objectionable and possibly illegal. Dealers are private businesses that sell parts at retail prices. There is no law, local, state, or federal, requiring cost pricing to retail customers, regardless of installation plans. Parts departments operate as independent profit centers with standard retail markup over dealer cost, typically 25 to 40% on most OEM components, which is identical to how any retailer operates across any product category. Dealers purchase parts from the manufacturer at wholesale dealer cost prices and retail them at published list prices. The customer's installation plans do not affect the wholesale to retail economics of the parts department's operations. No consumer protection statute and no automotive industry regulation creates a cost pricing obligation to retail parts customers under any circumstances. OEM parts are also available through dealer-affiliated online retailers, including Ford Parts Direct and GM Parts Direct, sometimes at meaningfully lower prices than in-store counter pricing. An option that exists and is accessible before the counter conversation becomes a dispute. Aftermarket alternatives from established brands including Bosch, Denso, and Delphi are available through AutoZone, O'Reilly, and Rock Auto at prices substantially below OEM list prices. The premium for a genuine OEM part over a quality aftermarket equivalent is the buyer's informed choice to make, not a markup that requires a legal remedy. Volume discounts, professional shop account pricing, and loyalty customer pricing exist at parts departments as business relationship decisions, not consumer entitlements. The parts department is a store. Stores charge retail prices. The installation plan is yours to manage. If the markup bothers you, the aftermarket was built for exactly that reason. 67. Karen has watched the strategy video, learned the secret technique, and has arrived at the dealership with a firm policy. She will lowball every used vehicle by 20% because every price on every lot at every dealer on every day has at least 20% hidden margin sitting inside it, waiting for a bold enough buyer to demand it. New vehicle margins were discussed earlier. Used vehicle margins are higher on average, $2,000 to $3,000 per unit at the front end. But 20% below asking price on a used vehicle represents a negotiating demand that regularly exceeds the total gross profit the dealer built into the transaction. A used vehicle priced at $22,000 with $2,000 of dealer gross contains $10,000 worth of demand at a 20% counter. The counter position exceeds the margin by $8,000 and produces one outcome: the conversation ends. Vehicles priced on active market data tools, including vAuto, are adjusted based on competitive local listings and days on market velocity. A vehicle that has sat for 45 days has already been price reduced in response to market signals. The 20% counter on an already adjusted price attacks a number that has been revised to reflect current market reality. The correct negotiating approach is arriving with a current competitive listing comparison for 2 to 3 comparable vehicles in the same market. Same year, make, model, trim, and approximate mileage, and presenting that as the basis for your offer. A dealer who has a vehicle priced in line with current competitive listings will explain that. A dealer whose vehicle is priced above comparable listings has a different conversation available to them. The 20% rule was a useful heuristic when pricing information was asymmetric and dealers had wider margins. Applying a 1980s negotiating strategy to a market with real-time pricing data and compressed margins produces a lot of rejected offers. 68. The mileage number is the only number that matters to Karen. Lower mileage wins every comparison, always, without exception, and she will pay a significant premium for fewer miles over a higher mileage alternative without evaluating any other variable, because mileage is the universal quality indicator she has used her entire car buying life. Mileage is one condition variable among several that interact in ways that frequently make a well-maintained higher mileage vehicle preferable to a low mileage alternative with a different history. A vehicle driven 25,000 miles annually on the highway by a sales representative experiences measurably less mechanical wear than one driven 8,000 miles annually in stop-and-go urban traffic. The engine cycling frequency, brake application rate, and transmission stress profile are fundamentally different between these use patterns. Low mileage vehicles that have sat for extended periods, estate vehicles, rarely driven second cars, collector vehicles, present specific issues that active driving prevents. Degraded rubber seals, contaminated brake fluid absorbing moisture, dried gaskets, corroded fuel system components, and flat spotted tires. These are condition problems generated by age and inactivity, not by use, and they don't appear on an odometer. Modern engine tolerances and synthetic lubricants have extended reliable vehicle life considerably. 150,000 to 200,000 miles is achievable on many current platforms with consistent documented maintenance. The threshold at which mileage signals meaningful concern has moved significantly over 2 decades of engineering improvement. Maintenance documentation, oil change records, timing component service, transmission fluid history is a stronger predictor of remaining reliability than the odometer reading alone. The price premium for low mileage frequently exceeds the actuarial value of the mileage difference when a well-documented higher mileage alternative is available at market price. Consumer Reports reliability data identifies which platforms are durable at high mileage versus which have age-related failure patterns. Mileage is one chapter. Read the whole book before paying a premium for a single number. 69. Karen has been an extremely loud customer for the last 45 minutes and is now informing the floor manager that she will be leaving a 1-star review, filing a complaint with every regulatory body she can name, and returning tomorrow with her attorney. All because the price didn't move from the 3rd counter to the 4th, and she believes the cumulative threat of consequences will force a capitulation that 4 rounds of negotiation did not produce. Regulatory complaints, negative reviews, and attorney involvement are legitimate consumer tools when they are applied to documented violations of actual regulations or documented deceptive practices. As a negotiating threat deployed because a dealer held their pricing position, they produce a different outcome. A dealer who has not violated any regulation has no regulatory exposure from a complaint filed in frustration. State Attorney General Consumer Protection Offices and the CFPB process complaints based on documented legal violations, not on the complaint volume generated by a buyer who wanted a lower price and did not receive it. Google reviews carry real business consequences for documented service failures and genuine consumer experiences. A review stating the dealer wouldn't go lower on the price is self-describing in a way that conveys less consumer harm than the reviewer intends. Attorney involvement in a standard vehicle negotiation where no fraud occurred is a personal financial decision that will cost more in billable hours than any price difference under discussion. The dealer has held a price because the market data supports it, the inventory carries a wait list, or the gross has reached a floor the store cannot go below. None of these situations is improved by a threat that applies to a different category of business conduct. The car business has real problems worth complaining about. A dealer who held their negotiating position is not one of them. Use the tools for what they were built for. 70. Private party buying is always better because dealers have overhead and margins and fees, and private sellers have none of those things, and therefore always sell for less. It is simple subtraction that anyone can perform, and the conclusion is always the same. Skip the dealer and save. Private party asking prices are frequently higher than dealer retail on popular vehicles because private sellers price based on retail market awareness, KBB private party value, recent comparable sales, and what they believe the vehicle is worth, not based on wholesale economics. KBB and Edmunds consistently show private party values 3 to 8% higher than dealer trade-in values, and often comparable to or above certified pre-owned retail pricing for popular, well-maintained vehicles. The seller knows what their car is worth at retail. They are pricing accordingly. Private party transactions provide zero statutory warranty protection in most states. Vehicles sell as is, with no recourse for issues discovered after the handshake unless the seller can be proven to have fraudulently concealed a known defect, a legal standard that requires documentation and civil action to pursue. Financing a private party purchase requires a personal loan or a specialty private party auto loan, typically offered at rates 1 to 2% higher than dealer financed rates on equivalent credit profiles. Manufacturer incentives, CPO warranty programs, and service relationships are exclusive to franchise dealers. Title fraud, odometer fraud, and undisclosed lien situations occur at measurably higher rates in private party transactions where no dealer licensing accountability exists. The legitimate advantage of private party buying: price flexibility with motivated sellers, access to specific vehicles not in dealer inventory, is real and situationally valuable. It requires more buyer diligence to capture safely than a dealer transaction. Private party buying removes the middleman's fee and the middleman's accountability simultaneously. Sometimes the math works in your favor. Know exactly what you traded away before you celebrate the savings. 71. The final complaint is the one delivered with the most confidence. You've spent 30 years as a savvy shopper, you know how this works, you've bought 8 cars in your life, and the experience accumulated across those transactions gives you a comprehensive understanding of current automotive retail that no salesperson is going to challenge successfully today. 8 car purchases spread over 30 years means one transaction approximately every 3 to 4 years, each in a different market condition with different inventory dynamics, different regulatory environments, and different information landscapes than the one you're standing in now. The pre-internet era had wide margins and high information asymmetry. The post-internet era compressed margins and equalized information access. The post-pandemic era introduced supply shocks, above MSRP pricing, and market dynamics that defied every historical pattern simultaneously. The regulatory environment changed with the FTC's CARS rule in 2024. Dealer management software has evolved to optimize deal structure in real time in ways that did not exist during earlier purchases. EV inventory, hybrid incentives, manufacturer direct sale models, and digital retail platforms have altered the landscape between each of the last several transactions in ways that accumulate into a fundamentally different buying environment than previous experience describes. The myths exposed across these 71 items are not random errors. They are the specific points where outdated information, borrowed confidence, and unverified assumptions produce the most expensive and most predictable mistakes in automotive retail. Every one of them sounded reasonable when it was repeated. Every one of them costs something when it's applied. The question is not whether you've been the customer described in this video. The question is which item made you pause, which complaint you've already delivered with full confidence, and whether you're willing to say so in the comments before you walk into the next dealership. Drop it below. If you want to see more, click the video on screen now.